Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello friends, today we are going to revise Security Valuation chapter. We have already done part 1 of revision, this is part 2. In part 2, we are going to be covering, or rather we are going to be revising mostly about fixed income securities, which are basically your bonds, debentures or some kind of securities which have conversion embedded in them. Okay, so that is the broad context of what our revision is going to cover. This is the second part of the Security Valuation chapter dealing with fixed income securities. So let's start off. And we can call it as bonds, debentures, it doesn't matter. So what I will do is, I will take you through key formulae and then discuss very briefly about the formulae, and then in between we'll go and look at some problems and try and cover comprehensively the entire chapter, both from a conceptual perspective as well as from an exam perspective, so that you are thoroughly prepared for the exams. Okay, let's get on with it. So if you don't have this formula sheet, please go to our website or our app and download the formula sheet. It is available under free resources under AFM, and the entire formula sheet is available for all the topics of AFM, and you can access it and you can use it for preparation. Students who have purchased courses from us will get this formula sheet free of cost in a printed form. So moving on, first part, what is a bond and how do you value a bond? So there is this formula for valuation of bond, which basically is very simply read is sigma, which is summation of all coupons and the plus the maturity value. All of them are taken at present values, and the present value is computed at a yield. It is very simply put, it is sigma present value of cash flow. That's all it is. This is very simple way of explaining, and this particular formula is just a unnecessary complication of that. It is summation of all the present value of cash flows. So it is basically, you see, P0 is equal to coupon into present value interest factor annuity, that is summation of all the present value factors from year 0 till the last coupon date or whatever that period is, and for a specific number of years and for a specific rate, which Y is basically the rate, which is the yield. And next is maturity value, which is present value interest factor, specifically the last year's present value factor for the same yield for the last period. Now here please note, what is this yield? This yield is known as yield to maturity, which is YTM or yield to maturity, or the word yield. All of these are interchangeably used. YTM, yield or yield to maturity. So this is what is basically the value of the bond. I will explain it to you simply in a slightly more simpler manner. So bond price is P0 is equal to C1 by 1 plus yield whole power 1, assuming that is an annual bond, plus C2, which is coupon. Now here this is in rupee terms, this is in percentage terms. Price of course is in rupee terms. So when you are talking about C, here it is coupon. Coupon is not the rate, coupon is the coupon absolute value. Coupon rate is C, percentage is coupon rate. When you talk of C, C is coupon absolute value in rupee terms. So C2 by 1 plus Y whole square plus so on and so forth up to Cn by 1 plus Y whole power n plus your maturity value divided by 1 plus Y whole power n. Basically these are all present value factors. You are summing the cash flows, all the cash flows. It is a very simple formula. Only thing, this is maturity value. Why are we so clearly specifying maturity value? Because there are cases where maturity value may be different from face value. You may be redeeming, or you may be or the bond at the end of the period, you may be paying out slightly at a premium or at a discount, which is why maturity value is known as M and not, you don't put face value. If they both are same, it is coincidental, but that they need not necessarily be same. Okay, now after having understood this, what are the key aspects here? Here we have assumed 1 plus Y and we are calling this as yield or YTM. Okay, simply put, this is basically the IRR. If this is the IRR, what is the price? See, typical IRR formula is, IRR is the rate at which present value of all cash inflows and cash outflows match each other. Present values match. But here we are saying something called as a price. So price is something that is quoted in the market. So taking the market price, if current market price is computed as, if you know the current market price, then you solve this particular equation to get the yield. If this is known, then you can get this. This unknown can be found out. Whereas it is other way around, ulta. If this is unknown and this is known, then you can find out the current market price. However, if both are unknown, then what will you do? You don't know the current market price, you don't know the yield, you just know that there is a bond which has some coupons. How will you find out the price of the bond? For finding out the price of the bond, you need to find out you need to have the yield. How will you get the yield? So what generally happens in the market is, you have bonds that are rated. Every bond has a rating. This is basically credit rating. So if there is a AAA bond, AA bond, A bond, B bond, BBB, like that, you will have varieties of rating. So typically what they say is, this AAA is going at equivalent government securities. So Government of India has also bonds. Government of India issues 5-year securities, 10-year securities, 15-year securities, and they issue something called as T-bills, which have maturity less than 360 days. So you have government bonds and T-bills, these are greater than 360 days, these are less than 360 days maturity. Okay, so you take these as the base. So government 10-year plus spread of 100 bips. So a AAA security will have a 10-year government, and I'm assuming here we are looking for pricing a bond of 10 years. So a 10-year bond is priced as, AAA security is typically has government 10-year bond plus 100 bips or 150 bips. Now I'm not saying that 100 bips is constant, or I'm not even saying that it's always 100 bips. Can be anything, depends on the market. So if your security has a rating of AA or AAA or A or B, you typically end up adding spread to this. So AA is AAA plus 100 bips. Something like that. So in the market, whatever are the current security ratings, and you look at comparable securities, you look at securities which have very similar rating or higher rating, lower rating, you take those ratings and then you add a spread to that. You add a spread. Spread is basis points. What is basis points? Basis point is equal to 1 basis point is equal to 1 by 100th of a percentage. That is 100 bips is equal to 1 percentage. So when you talk about 2.50%, it means 2.50%. So you basically say 2% plus 50 bips. Okay, so this is what is the basis point. So you add certain spread based on the rating of security and then figure out what is the ideal rate. That will become the yield to maturity. So market rates will determine the yield to maturity. Based on that yield to maturity, you can compute this particular price. If you don't know both of them, this is how it is done. That is how it happens in the real market also. Now, some companies may negotiate. So some companies may broadly be in this range of 100 bips, but some of them may be 97, some of them may be 1 or 2. Let us say both HDFC Limited, HDFC Bank and Reliance are AAA rated entities. For AAA rated entities, ideally the spread, let us say, assume is same 100 bips. But Reliance, because of its strength, may command a spread of only 97 bips. HDFC may command 102 bips. Right. So like that, it may vary from company to company, but broadly it is in the same range. Now, having understood how this is done, let us get back. Right. Now, what is the alternate formula? There is also an alternate formula. Which is P0 is equal to C by Y into 1 minus 1 by 1 plus Y power n plus M by 1 plus Y power n. Now, please don't unnecessarily complicate this. See, how this is arrived is simple GP. Sum of GP. What is sum of GP? A into R power n minus 1 by R minus 1. Okay, if for a finite GP, A into R power n minus 1 by R minus 1. So, you take C by 1 plus 1 Y as A, then you take R as 1 by 1 plus Y, and then you fit it into this particular equation. In this particular formula, you will get this as a solution. So, no need to mug up or remember. Please think of it as very, very simply sum of present value of cash flows. That's all. Okay, no need to remember this formula. I actually, in this particular chapter now specifically, other than 1 or 2 formulae, I strongly suggest that you don't remember the formulae. Please remember the concept, because unnecessarily people will be, you will overthink. You will unnecessarily overthink. Anyway, so this is one. Now, second aspect that I want to highlight when we are talking about this is something called as bond value when coupon payments are semi-annual. Now, so far we have taken a case. Where is this? We have taken a case here where we have assumed that yield is annual. Okay, where you have assumed that coupon payment is annual. That is the underlying assumption in this. However, if the coupon payments are not annual, coupon payment, let us say I will tell you, there is a bond, face value 1000, coupon 7%, payment semi-annual. Okay, then yield, current yield based on the current market prices. Okay, based on the current interest rates of government securities, what all I told you, right? So, let us say the yield is now 8%. Then, how do you value this bond? This bond is valued as, and let us say term to maturity or balance term to maturity. Balance term to maturity. Let us say 3 years. So, what you do is exact 3 years. Okay. So, first coupon is received when the half year, because it is a semi-annual coupon. So, you receive 3.5, then you receive another 3.5, then 3.5, then 3.5, like that you receive for 6 periods. This 3.5 you do not divide by the yield. Let us say this yield is 8%. You do not divide it by 8%. You divide it by 8 by 2 because number of periods. So, this one will be 1 plus 4 square or 1 plus 4 square, 1 plus 4 whole cube, so on and so forth. So, you basically this yield is divided by the number of interest rest. So, the interest or number of the coupon payment frequency, and here you have taken the coupon value. Please note, you have not taken 7%, you have taken 7% into 1000. 7% into 1000 is how much? 70. 70 into 2 into 1 by 2 is actually 35. So, I should not even take 3.5 here, I should take 35. That is the right thing. So, 35, 35, 35, 35, 35, 35. So, coupon is 35 bucks. That 35 bucks you bring it to present value by dividing it by 1 plus yield by the number of interest rates. Okay. That is how you actually compute the yield. So, if you come back and look at this formula, sigma 2n, what is n? 2n is maturity period expressed in terms of half yearly period, and c by 2 which is the coupon, y by 2 which is basically the yield also taken half, t for every half year you take as 1, and here 1 plus y by 2, again this also is done as half power 2 times the number of years. It is see, you divide the interest rate by 2 and you multiplied the the years time by 2. That is what you have done. Okay, that is how you get if it is a semi-annual. If instead of semi-annual, let us say this is quarterly, then what will you do? This will become 4n. So, this will be 4, this will also be 4, this will also be 4, this will also be 4. Everywhere you compound it 4 times and you divide the interest rate by 4 so that when you compound it 4 times, you will actually, you are accounting for both the aspects. So, this is how you do if it is a semi-annual or a quarterly coupon. So, friends, after having understood how bonds are to be priced when coupons are semi-annual or not necessarily annual but are quarterly or something like that, let us move to the next aspect which is very critical for us to understand, which is the price-yield relationship. What is this price-yield relationship? Price-yield relationship basically talks about what happens to the price of a bond price when yield goes up or goes down given coupon is fixed, given that the coupon is fixed. Now, the way to look at it is, let us take a simple example. Let us say there is a bond, face value is 1000, date of issue 1120x1, bond maturity is 3 years, coupon is 7%, YTM, current YTM as on 1720x1 is 8%. So, balance maturity is equal to what? Balance maturities 20x1 till 1st Jan 20x1 till 1st July 20x1. 6 months have passed out of total 3 years. So, balance maturity is 2.5 years. Bond is plain vanilla. What do you mean by plain vanilla? Plain vanilla means there is no premium or discount on redemption or on issue. There is no optionality attached to it. Plain vanilla means no options, no premia by discount. Okay. It's a plain bond, simple bond. Why I am saying simple? What are these options? We will discuss that later, right? There obviously we are going to cover that. Now, in this kind of a scenario, how do you price the bond? Price on 1720x1. They are not asking you the price on date of issue. On the date of issue, typically you will price the bond in such a way that the face value is equal to price of the bond, so that your yield and coupon are same. What do I mean by that? You will understand this. You see now, we are supposed to find out price on 1st of July. First, let me find out price on 1st of Jan 20x1 on the date of issue. See, coupon is how much? 7%. On that day, I have assumed, I have decided the coupon is 7 because market rate is 7. So, what happens is, you have how many years? 3 years. So, the end of first year you have a payment of 70, end of second year you have a payment of 70, end of third year you have a payment of 70, and end of third year you also have a payment of 1000. So, 1, 2, 3, 3. Now, on the issue date, usually coupon rate and YTM are same. See, because you are issuing the bond, you know what is the yield of a similar instrument in the market. So, you will put the coupon as equal to the yield, because you are the company who is issuing the bond, right. So, are same. So, what will happen to this? YTM is what? YTM is equal to 7%. So, 70 by 1.07, P0 is equal to 70 by 1.07 plus 70 by 1.07 whole square plus 70 by 1.07 whole cube plus 1000 divided by 1.07 whole power 3. So, what will this be? This will actually work to 1.07. 1 by 1.07 is equal to 1, 2, 3. GT 2.6243 into 70 plus 0.816 into 1000. That will be 183 plus 183.7 plus 816.3. So, the yield, the rate at which you discount the bond on the date of the issue, typically more often than not is the coupon rate, because you will price your bond such a way that the coupon is equal to the yield. So, this is the first part. Now, coming back to our second case, and here I would like to make a small change. Instead of pricing the bond on 1.7, I will slightly change it to pricing the bond on at the end of first year 1120x2. So, balance maturity is 2 years, and we are supposed to find out now the price after 1 year. So, after 1 year, yield has gone up. The market interest rate, the expectation of the interest rate from a similar kind of a bond with similar rating is now 8%. Whereas, you are giving a bond which is giving only 7%, that is 70 rupees on 1000. Whereas, market, anyone issues afresh, they are giving 8%. So, you will discount the cash flows by 8%. So, what will happen? 70 by 1.08 plus 70 by 1.08 whole square. Why is and this is for 2 years. Why 2 years? From 20x2 1120x2 to 311220x3. It's a 3-year bond, of which 1 year is over. So, balance 2 years, you are finding out the price. You are on 1120x2. Okay. So, the price will be 70 by 1.08 plus 70 by 1.08 whole square plus 1000 by 1.08 whole square. So, this will be 1 by 1.08 is equal to once, twice, GT 1.783 into 70 plus 0.8573 into 1000. This will be 982. So, you see, when the market yield or the yield to maturity or the expectation of the market increases and you are paying a fixed rate, that is why I told you plain vanilla, there is no option, no premium, no discount, and the rate is fixed. Fixed at what? At 7%. Then your future cash flows are discounted at a higher rate. When they are discounted at a higher rate, the present value falls. So, when yield and price, yield increases, price decreases, yield decreases, price increases. So, this is an inverse relationship. Inverse relationship. So, exactly ulta happens if the market yield is not 8%, but market yield is, let us say, 6%. You will discount everything by 6. So, this value will be, instead of being 982, will be some 1020 or something. I am just making an estimate, I do not know what it is, right. It will be higher than face value. So, this is a very, very important aspect that you should know. Now, coming back, now we have discussed that when yield is up, price is down, right, assuming that the coupon is fixed. However, please note one more thing. When we took the example, I said at the issue price 7 and 7 both are same, yield and coupon are same. When yield is greater than coupon, that is when yield is greater than the coupon of 7%, that is market yield increases, bond price comes down, that is it sells at a discount. When I said 6%, this is 981 and this is 1020. When yield comes down and the coupon rate is same 7%, the price increases. So, bond sells at a premium. This is the logic. Now, we have discussed the relationship between yield and bond price. However, there are certain other things also, relationship between time and bond price. What is this time and bond price? See, what happens is, if the bond is trading at a premium, that is, let us say in this particular case, we have said that because there is 2 years of maturity, because yield has come down, bond price is going up. But on the last day, this is 2 years before, but just 1 day before maturity, will bond price be 1020? Bond price will be close to 1000. Why? Because 1000 is the money that you are going to get. And this higher or lower interest rate does not have an impact for last 1 day. It will have an impact when the time is high. So, if bond is trading at a premium, its price will decrease over time to face value or redemption value. I am assuming redemption and face are same, it is a plain vanilla bond. Same logic applies. If bond is trading at a discount, price will increase over time till redemption value. So, even though the bond price and the yields are inversely related, the bond price, despite yields not being same as coupon, over a period of time, the bond price, let us say bond price is here, this is the face value. The bond price initially, because the yields are low, bond price is high. Slowly bond price will come down to the redemption value, or bond price is low, but as the time elapses, the bond price will come and start meeting the redemption value. This is another important thing that you should note. Now, there is something called as a zero coupon bond. What is a zero coupon bond? These are bonds which are issued at discount to face value. Basically, there is no coupon. So, there is no coupon, it is just 1000 rupees, it is just 100 rupees is the face value, it is issued at a discount. So, the interest accrues on the discounted value. When a ZCB matures, the investor will receive one lump sum which is face value equal to the initial investment plus interest that has accrued on an investment made. ZCBs are usually issued for long tenure. So, if you think of a ZCB issued for 3 years when market yield for a similar bond is 8%, it is very simple. On day 0, as a loan, you take some money. Year 1, year 2, year 3. At the end of year 3, you repay 1000. There is no interest payment in between. So, this 1000, how much will you give me if you have to give you back 1000 after 3 years without any interest in between? You will say present value of 1000. So, 1000 divided by 1.08. Why 1.08? That is the annual yield. Once, twice, thrice. So, 793. So, if somebody gives you 793 today and market rate of return on market interest rate or market yield for a similar kind of a loan is 8%, then 793 is the discounted value and 1000 is the repayment value, so that 8% accrues on 793 compounded basis on an annual compounding for 3 years period to come at 1000. So, it is a very simple logic. Okay, zero coupon bond means there is coupon value is 0. So, all payments are 0 except for the maturity payment. So, initially you invest 793, you get back 1000. So, in between what happens? Interest accrues on this 793 at same 8%. Given this 8%, you can find out 793, or let us say you are given 793, you can find out 8%. Okay, you need one of them to find out the other. Okay, so this is a zero coupon bond. So, that is how a zero coupon bond works. Now, there are certain other concepts called current yield. What is current yield? It is simply coupon by current market price. Now, this is not YTM. This is not equal to YTM. Okay, it is just a measure. Okay, it is not a relevant measure. It is not actually, very rarely it is used in the market. Whatever is a coupon divided by the current market price, you take it as current yield. People are more bothered about YTM rather than bothered about current yield. Current yield may be looked at for short term investment purposes. Let us say next month I am going to get 10 rupees as the yield, 10 rupees as the coupon. What is the current market price? So, what is the yield? That is all. Beyond that, there is no logic to it. They do not use it much. You may get this question may be asked once in a while in the exam, but otherwise I do not think that particular thing is relevant. Now, key thing about YTM. See, I have told you that when yield is given, price can be found out. So, let us say coupon is 7% and yield is 8%. You can compute present value at 8% and find out the price, right. However, what if price is given as 110, and your face value is 100, coupon is 7, yield is equal to question mark. How do you find out that? You have to do an interpolation exercise. You have to basically do an interpolation exercise. So, we will take an example. Let us take a simple example to understand this part. A bond with face value of 100, okay, coupon rate of 11, maturity of 3 years is selling at 96.6. So, price is known. Calculate the YTM. Now, here we will assume it is annual coupon, very simple. So, if it is coupon rate is 11 and it is selling at a discount, please come back to this point. If it is selling at a discount, when will a bond sell at discount? A bond will sell at discount when yield is greater than coupon rate. So, you take the first assumption of yield as 12%, which is higher than the coupon rate. When you take yield at 12, compute the present value of the coupon payments, compute the present value of the bond. Okay, assuming, okay, this is balance maturity. Okay, balance maturity. We don't know when the bond was issued and all that. So, 11 rupees into present value annuity factor at 12% for 3 years, you get something, and 100 rupees in present value factor for 12% for 3rd year, you get something, you get 97 rupees. But actually, the price is 96.6, whereas you got 97. So, at 12% you got 97. If you make it further higher at 13%, what will happen? See, if at 12% it is 97. If you increase the rate, price will come down further. What is the relation between these two? This is higher, this is lower. So, you have to increase the rate higher to 13%. In some cases, let us say this is 96 and when you do it at 12%, let us say this comes to 95. Then at 12% it is 95. So, if you have to arrive at a price of 96, you have to increase the price to 96, the yield has to reduce. So, instead of 12, you have to do probably 10.5 or 11.5. I don't know what rate it is. You have to do some rate. So, if you have to choose the direction in which, you have to figure out the direction in which this price has to go and then choose an interest rate or yield which will move this towards this. Okay, so you choose a 13% yield so that the rate comes down further and approaches close to 96. So let us see, 11 rupees present value annuity factor at 13% for 3 years, 100 rupees present value factor at 13% for third year, you will get 95.27. So you see, at 12% it is 97, at 13% it is 95. So for a 1% change it is 2.351. So for 1% change in yield, the change in interest rate is change in the value of the bond is 2.351. However, we want the bond to be priced. What is the price of the bond? Price of the bond is 96.6. So it has to be in between these two, 96.60, no? What is that? 96.60. So it is a rate in between these two. So the way you do it is, see, there are two ways. One is you use a formula, this particular formula. Other one is simple logic, and the formula and logic go together. For a 1% change, there is a change of 2.351. Okay. From 12%, it has to come down. From 12%, it has to increase by how much? X percentage, such that at 12%, the value is 97.622, and at X percent, the value should be 96.60. That is, there has to be a change of 1.022. So for 1% change, the change is 2.351. For X percent change, the change should be 1.022. What is the X? So for 1%, it is 2.351. For X percent change, it has to change by 1.022. So what is this X? You basically cross multiply. So 1 into 1.022 by 2.351. So 1.022 divided by 2.351. It will be 0.43%. At 12%, it is 97.62. Now, the rate has to come down from 97 to 96. If it has to come down, you have to add a rate or subtract a rate. If the rate increases, price decreases. So, if the price has to fall from 97 to 96, you have to add this 0.43. Is this 0.43? It is 0.4347. So, I will take 0.435. So, you add 0.435 to 12. So, you will say at 12.435, the yield will be, at the yield of 12.435, the price will be 96.6. If you have not understood this, there is this formula. This is a very simple logic. There is nothing complicated. Just think about it for 5 minutes. The formula is, yield is lower rate, which is 12%, plus NPV at the lower rate. What is NPV? 97.622 divided by NPV at the lower rate minus NPV desired. Okay, there is a correction in the formula. NPV at lower rate minus NPV desired. What is NPV at lower rate? 97.622 minus 96.6, which basically will give you 1.022, right? Lower rate, which is 12% plus, see, it is here 12% plus 97.622 minus 97.6 divided by NPV at lower rate minus NPV at higher rate. What is the overall change because of the change in yields? What is the overall change in prices, which basically is 97.622 minus 95.231, which is 2.351. 97.622 minus 95.271, yeah, which is 2.351. So 12% plus desired change of 1.022 divided by 2.351 into 13 minus 12, basically high rate minus low rate, 13 minus 1, which is 1%. So you basically end up at same thing, 12.435. I also did the whole exercise and arrived at the same number. So it is a very simple calculation. Sometimes there is also a method which is where you approximate it. This I usually don't like it, but in case they ask it, give an approximate method, you can give it, or you can do this also. They will not deduct any problems if you do the right way. Okay, the right way is this is approximation. So what is the formula? This is an approximate method. I typically don't like it. The formula is coupon plus or minus the face value or redemption value minus the market price divided by the maturity, whole thing divided by average of the current price and the redemption value. This is a very approximate method. You will typically not get the right answer. So I would definitely not use it. Okay, then I explained to you what is basis point. Then we have something called as yield to call and yield to put. Let us have a look at what is this call and put. So friends, now after having understood how we can compute the yield when price is given using specifically the interpolation method. Let us move to the next aspect, and after also having understood, what is the approximation method, which is typically not preferred, let us move to the next aspect, which is basically yield to call and yield to put. What are yield to call and yield to put? What is call, what is put? So, if you've gone through the derivatives chapter, a call is a right to buy. Put is right to sell. Right. This is what generally you've learned in derivatives chapter. Now, when you come to the bonds chapter, it is same right to buy, but then once a bond is already been issued to a bondholder or investor is already holding the bond, who has a right to buy back from the bond from the investor or debenture holder? The company. So, the company can call back the bond at any point of time. So, the company has a right to call. So, the company has a right to call. So, this is company can buy back. Now, bonds come with this optionality. Optionality is where the company has a right to call back the bond and pay off the money at any point of time. When will a company do that? Think of yourself. You have given a loan to somebody and the loan is given using some loan documentation. There is a stamp paper. Bond is equivalent to stamp paper. Okay. Now, that particular loan, what you have given, when will you want to repay the loan? When you have excess money. Or assuming that the loan that you have taken is taken at a higher rate of 10%, 11%, 12%, today you can get a same kind of a loan at 5% or 6%. What you will want to do? You will call back the existing bonds, that is, you will repay the loan and by taking a fresh loan. So, you will basically call the existing bonds and you will refinance the existing loan with a new loan. So, when interest rates fall on a fixed coupon, bond is at a risk of being called back provided such an option exists within the particular bond at the time of its issuance. So, what I mean is, at time of issuance, company states when it can call. Okay, this is one thing you remember. Same way, or when you can call back the bond. Okay, call back the bond. Okay. Put is when the investor, that is the person who has invested in the company, or rather the person who has lent to the company, has a right to sell the bond back to the company. So, put is what? A right to sell. In case of bonds, investor sell back to company. So, when will an investor do? Exactly ulta. When market interest rates are much higher and this particular person has lent money at a much lower rate, this person will say, boss, bahut ho gaya, you take back your bond, give me back my money, because you are giving me paying interest of only 5%, market my interest rate is 11%, so you take back the bond, give me my money, I will lend it to somebody at 11%. But this option also, option to be built into the structure at time of issuance. So, this cannot be randomly, anybody cannot say it, today I am calling a bond, today I am putting a bond and all that. No. Bond should be a callable bond or bond should be a puttable bond when it was issued at that particular point of time as per the documents, the bond documentation, whatever is there, or the debenture deeds and the debenture agreements and all that. Going in those documents, you should specify what kind of a bond, whether the bond has an embedded right to be called or to be put. If there is such a right, then you will value the bond accordingly. This is very important to understand. Why is this bond call or put important? Because based on such a right, the value of the bond will change. Why will the value of the bond change? See, what is a bond? Bond is basically a right to receive cash flows. Simple bond, right to receive cash flows, right, discounted at a yield. Okay, basically YTM. Now, if the same right to receive cash flows suddenly changes, the right changes, you no longer have a right because the company has called the bond, or the company no longer has the obligation to pay because you have put the bond, that is you have sold back the bond, then the cash flow series changes. So at a certain point, the cash flows will stop. Or at a certain point, the company will call back the bonds, or the investor will sell back the bonds by exercising the put option. So, which is why as market interest rates go up or they come down, if there is a call or put, then the pricing will be subject to that call or put option when the interest rates change, given that there is a specific coupon. So, what I mean by this is, assume there is a 7% coupon bond and this is a 5-year bond, can be called by company after 3 years till year 4. You can have any kind of structure. Between year 3 and year 4, you can call the bond. Now, between year 3 and year 4, let us say the coupon, and let us say, and there is, assume that there is a call. You can also add that whenever the bond is called, there is a premium, there is a discount, something like that. You can add many such features to the bond. Now, between year 3 and 4, let us say the interest rate in the market is, let us say, 2%. So, the company can now borrow at 2% instead of 7%. Instead of 2, they can borrow, instead of 7, they can borrow at 2. So, the company will say, between year 3 and 4, I will call back the bond. I will repay the loan and borrow fresh money. So, in such kind of scenarios, how do you price the bond? Let us see. So, if the interest rate is 2%, I said you will put the investor has a right to call back. So, if the interest rate, let us say, is 2% between year 3 and 4, the company has a right to call back the bond. But let us say the terms of the bond also say, company can call back between year 3 and 4 at rupees 110. Okay, even though the bond face value is 100, when you call back, it has to be called back at 110. That is, you have to buy it at a premium. So, when interest rates start falling, the bond price increases. But the bond price will increase till what point? Till a point it reaches 110. At 110, the company will say, chalo. Now, it does not make any sense for me to pay interest rate which is much higher than market rate. I will pay till the market price is 110. Moment the market price touches 110, I am indifferent between my existing loan as well as a new loan, because both the prices are same at 110. And if the interest rates are expected to go down further, then I may as well borrow afresh rather than borrowing it at this 7%. So, what you will do, the way this bond will be priced is, the way this particular bond is priced. Let us see. Call option is right held by company to prepay a bond after a certain date at a predetermined price. It is a part of the terms of the issue of the bond. Companies generally call back their bond when market interest rates move lower than the coupon rate, which is what I was telling you, 2% versus 7%. Yield to call is a return that is a bond that a bondholder receives if the bond is held until the call date. So, it can be calculated by using the following equation and interpolation method: C by 1 plus y power 10, sigma of basically summation of all coupons, plus call price. So, what is the call price? So, if you are going to buy it at 110, so at that price, right, by 1 plus y power n. So, this is the yield. This is the yield on such kind of a bond. You compute the yield on a callable bond by using this particular method. Okay. Same way, how do you do yield on a puttable bond? Puttable bond is exactly ulta, which is the investor, the bondholder has a right to sell it based on predetermined terms at a predetermined price to the company, sell back to the company. Now, when will a bondholder sell back the bond to the company at his or her option? Put option is right held by bondholder to sell back the company or on after a certain date at a predetermined price. It is also part of the terms of the issue of the bond. Investors shall generally sell back when the market rates move higher than the coupon rate. So, market rate is 10%, whereas the bond is, let us say, 5%. So, as the interest rate increases, market rate is 5, this is market, this is coupon. Okay. Now, what happens? As interest rates increase, what will happen? Price of the bond falls. Interest, price. As interest increase, price falls, correct? So, price will keep on falling, and puttable bonds, you will, the right to sell back to the company is at a discount to the face value. So, let us say 100 is the face value and puttable price is, let us say, 80. So, the price keeps falling from 100, and the day it reaches 80, the existing bondholder is indifferent between the, having this bond of 80 or selling back to the company at 80, because once they sell it back to the company at 80, they will get that 80 and they can invest it at 10% or 11%, whereas if they keep it with this company, they will only get this 5%. Okay, so in such kind of a scenario, what is the price of the bond or what is the yield to put of the bond? Yield to put of the bond is the rate at which current market price is arrived at, where you take the put price instead of taking the redemption value, which is to maturity value. In between itself there is a maturity, so for till that date, whatever is the maturity price, you compute, instead of taking M, you take put price. Instead of M, you take P. Okay, maturity value, which is the final redemption value, instead of that you take the put price. It is a very simple formula. Now, so far they have not asked questions on this, but at some point they may ask, is my expectation. Now, we have understood the previous aspect which we discussed, which is price and interest rate. So, the relationship is inverse. That is, if interest rates increase, price decrease. If interest rates decrease, price increases. However, please note one more thing. What is the relationship with respect to time? A longer the maturity of the bond, greater the change in bond price for a given change in yield or required rate of return. What are they talking about it here? Price, market interest rate, inverse. Correct? Here they are saying longer maturity, what is the exact word? Longer the maturity of a bond, greater the change in the bond price for a given change in yield. Longer the maturity, price more sensitive to yield changes. Why are they saying that? You see, when you look at a bond price, right, P0 is equal to C1, C2, C3, this is present value, so on and so forth, M present value, correct? This is what it is, summation of all of this, correct? Now, let us say, and let us assume this is years, 1, 2, 3, so on and so forth till year N. Once you have taken this price of the bond as summation of coupons and maturity value, and you have assumed over a long period of time, from 1 to N, even for a small change, so let us say there is a 1% change in the yield, 1% change in the yield, 1% change in the yield. What will that 1% change in the yield do? It will go and affect all the cash flows over a very long period of time. Now, if you put this in Excel, you will understand it much better. What will end up happening is, the impact on, if the tenure is very, very long, even small changes in interest rate will lead to change in all the cash flows, because of which the overall change in price is much higher. However, the same tenure is very, very short. Tenure, same coupon but short tenure. The change in price due to change in interest rate is very, very small. I will just give you a simple example. So, let us take two bonds, bond 1, bond 2, maturity 1 year, maturity 5 years. Coupon let us say is 5%. Both cases, let us say it is 5%. Face value 100, 100, redemption value 100, 100. Okay. Now, issue today on day 0 it is issued, on day 0 it is issued. Now, yield, argument sake, current market interest rate for 1 year as well as for 5 years, let us say is 5%. Typically, for longer duration, you will have higher interest rate, but for shorter duration, you have lower interest rate. Assume for argument's sake, it is 5 in both the cases. Then, if the yield changes from 5% to 6%, changed yield, okay, on day 0 itself, next day morning, let us say yield changes to 6%. What is the impact? How will you price? Present value annuity factor of for at 5% for 1 year into 5, which is your coupon, and this is not 5%, this is 6%, because the change yield is 6, plus 100 by 1.06. Simple, right? So, basically 105 by 1.06, correct? Because you are having at the end of the period you will get 5% as coupon and you will get 100 back as redemption value. So, 105 by 1.06. So, the price will be 99.05. Whereas, if you reprice this particular bond at 6%, what will happen? 1 by 1.06. 1, 2, 3, 4, 5. So, it will be plus 0.747 into 100 and GT is 4.21 into 5. 4.21 into 5 is equal to plus 74.7. You will get it the value as 95.76. So, see, both bonds 5%, but both bonds, let us say there is a change in yield to 6%. Because this is a 1-year bond, the price has changed from 100 only to 99, whereas this one the price has changed from 100 to 95. Why? Because all the cash flows are spread over a period. Each cash flow is affected by the present value. The effect is much more larger on all the cash flow aspects. So, if there are multiple cash flows and everything is affected by the change in price, obviously, and each one is one after the other, that is you have a longer duration, then obviously the price will be more sensitive to change in yield. Whereas here there is only one cash flow, and that cash flow is also very near term. It is just 1 year. If something is very close, the change in interest rate doesn't affect. If something is very far off, the change in interest rate affects it. That is the basic logic. Now, after having understood this, let us look at this aspect. Price volatility is higher for a longer maturity bond and lower for a shorter maturity bond. We have understood the logic now, because every year, if they have lot of years, you have to discount all of them, and the impact of change in interest rate on farther away things is much higher than closer things. Whereas when you come to coupon, if you have a lower coupon bond, price volatility is high. If you have a higher coupon bond, price volatility is low. What is this logic now? What we are saying here is, let's take two bonds, one bond, two bond, both of them 5 year. First one, let us say, is 3% bond, other one, let us say, is a 10% bond. Okay, and face value is 100. See, typically, if they are both of same tenure and the companies of same type, you will have same interest rate. But here I am assuming just for helping you to understand. Then change in interest rate plus 1%. So, this goes up to 4, this goes up to 11. Okay. Then price of bond. What is the price of bond? You will have 3, which is the coupon, into present value annuity factor at 4% for 5 years, plus 100 into present value at 4% for 5th year, versus 10 into present value annuity factor at 11% for 5 years, plus 100 into present value at 11% for 5th year. Now, you see these two, assume initial both of them were priced at same 100. But after the change in interest rate, what is happening? This will be 3 into 1 by 1.04 for 5 years. 1, 2, 3, 4, 5. So, this will be 100 into 0.8219 and GT 3 into 4.4518 into 3 is equal to plus 82.19. That will give you 95.545. Whereas, if you do the same thing for 5 years pricing at 11%, 1 by 1.11 is 0.909, 1, 2, 3, 4, 5. So, this will be 100 into 0.5935 plus 3.695 into 10 plus 59.35. The price will be 96.30. You see which one is more sensitive? The one with the lower coupon is more sensitive. The one with the higher coupon is less sensitive. See, the one with the lower coupon is more sensitive and one with higher coupon is less sensitive. This seems counter logical. Why is that the case? I will tell you. So what happens? Why this? Why is this kind of a scenario happen? Why does this happen? That is, a lower coupon bond is more sensitive than a higher coupon bond. See, what is P0? Again, same logic. C1 plus C2 plus C3, all of them at present value. Till maturity value, present value. This is the summation. Now, when you take the weights of these items, if the coupon is high, the weightage of this portion is high, correct? This portion is low if coupon is high. If coupon is bigger, the weightage of this portion is bigger. That is a simple logic. If there is a change in interest rate, the impact on the maturity value for which the weight is also low. But this does not impact the price so much. What impacts the price? Only these. And these are where? These are closer to the date. These are closer to day 0. Right? Maturity values at the end. But C1, C2, these are far closer. So, if you have something closer, the impact of change in interest rate hits it lesser. Because this is a higher number, that is C1 plus C2 plus C3, all these are bigger numbers. Because the coupon rate is higher, the impact of change in interest rate on them is smaller because they are far closer, whereas maturity is far further away. So, if the coupons are high, the overall impact of change in interest rate is low on it, whereas if coupon is small, most of the value, so you just take C0 plus C1 plus same thing and maturity. Now, let us say this is 1 rupee, 1 rupee, 1 rupee and this let us say is 100 rupees versus this is 10 rupee, 10 rupee, 10 rupee and this is 100 rupees. The impact on this is much smaller. In this case, impact on coupon is smaller compared to impact of coupon is small but they have higher weight. So, on overall basis what happens? This higher weight, the impact on coupon, that negates the lower weight of 100, the maturity value, whereas in other case, these all have very low weights. The impact on them is small. So, low, so impact is low on this, but on this the impact is very high. Why? Because this has very big weight. So, entire impact comes into this. So, the entire change comes into the maturity value. The maturity value will start playing an oversized role, because of which what happens? This is what happens. When your interest rate from 3% to 4% changes, the price moves to 95. Whereas from 10% to 11%, the price only moves to 96. There is a smaller change in the price of the bond when coupons are larger because they have more value. Because and when you are computing present values, most of the value of the bond is coming from present value of near term items than long term items, which is why the impact on high coupon bonds of change in interest rate is much lower than low coupon bond. See, if you have very high coupon bond with very long tenure and a low coupon bond with low tenure, you have to compare both of them individually. One cannot make random statements that this is high, that is low, because we don't know the interest rates, we don't know what is the tenure, how they will play. It is simple mathematical equation. You have to just put it, see how the values arrive at. Okay, fair enough. Now, coming back, we will summarize it like this. Price volatility is higher for a longer maturity bond and a lower coupon bond, and price volatility is lower for a shorter maturity bond and a higher coupon bond. So, friends, the next concept what we are going to discuss, as I said, is a very interesting one. It is bonds basic value in between two coupon dates. Now, before we get into this, I want to tell you certain things. So, what is this in between date thing what we are talking about is, let's say there is a bond. Let's say there is a bond which is issued on 1/1/2020 yearly coupon for 5 years. How do you find out the price of a bond on 1/7/20? That's all. How do you find out the price of the bond? When in between period, what is the basic price? What is the price of a bond? Now, please note, when you talk of price of a bond, in between the coupon dates, you actually have a terminology called clean price dirty price. Clean is basic value of the bond. Dirty is clean or basic plus accrued interest. Okay, this is something you have to remember. And please note, this is very different from something called quick and dirty. There is something called quick and dirty method. Quick and dirty and this are very different. Quick and dirty is this. Where is that? There was one formula here, no? This is called quick and dirty. This approximation method, no, is called quick and dirty. Don't confuse a quick and dirty method with clean price and dirty price. Clean price is basic value of the bond. Dirty price is basic value plus accrued interest. And when will this whole accrued interest concept come in? It will come in only when you are pricing a bond in between coupon dates. Now, let me take you through an example before I actually explain the formula, because I think an example will help understand the formula better. Purchase date of the bond is 1st March. You have purchased it on 1st March. Face value of the bond is 1000. Coupon is 10%. Maturity is 31st December 2029. So it is, I don't know when the bond was issued, but maturity is 29. Coupon payment semi-annually on 30th June and 31st December. Now required return or current yield is 12%. You are now required to find out the price of the bond on the bond purchase date of 1st March. So what you will do is, you will use this formula. Present value of A plus coupon minus accrued interest. Okay, so if you come back to this, I have mentioned here basic value plus and accrued interest. Dirty price is basic value plus accrued interest. There, what we are doing? Present value of A plus coupon minus accrued interest. There I am talking about plus interest, here minus accrued interest. No confusion. It is all same. Don't worry about it. Here we are talking about the basic value. We are not talking about accrued interest, we are talking about basic value. So, we are talking about this price. So, you are computing something called X, from that you are subtracting accrued interest and you are calling it basic. This is also the clean price, and this X is basically the dirty price, which is basically your basic plus accrued interest. That's all is the logic. Okay, there is nothing complicated in this. Okay, now the formula is you price the bond, present value of A plus coupon. What is this A again? Forget that A plus B, what I was discussing earlier. Just think of this formula as present value of A plus coupon. A is defined here. A is bond price calculated on the next coupon date after the payment of coupon. So, in our case, purchase date is 1st March. When is the next bond payment made? 30th of June. So, you are going to compute now the price of the bond on 30th of June, end of day, immediately after making coupon payment. So, what will happen? How will you find out the price of the bond? See, you have from 22 June. So, 22 June meaning December is 22 June, payment is over. So, December you have one payment of 22, then you have 23, 24, 25, 26, 27, 28 and 29. So, you have 7 years of full payments, which is basically 14 payments, and you have one payment in the current year. So, you have 15 payments. So, you see 15 payments. You have 15 payments and the yield is 12% per annum. So, when you do semi-annual, you take half of it, which is 6%. So, what you do is, you price the bond on 30th of June, end of day, after coupon payment is made for the next 15 coupon payments and the redemption value of 1000 at 6% semi-annual discount rate. So, what do you do? And it is coupon rate is 10%. So, 10% on 1000 is 100. So, half yearly coupon is 50. So, you take 50 multiplied by present value interest factor annuity for 6% for 15 years and 1000 present value interest factor of annuity and 1000 present value interest factor for 6% for the 15th year alone. You get a value. You got this as 902.88. This 902.88 is basically the price of the bond on 30th of June, end of day, after making the immediately succeeding the interest or coupon payment. Now, this is 902 plus you add the coupon value. On that day coupon is paid. How much coupon is paid? 50 rupees. So, you add that 952.88. So, the value of the bond on 30th June is 952.88 before making the coupon payment. So, after making it is 902, before making 952. This 952 you take present value. This 950 you do present value. What is the formula here? present value of A and coupon, and A is present value of A and coupon, and A is basically the bond price after next coupon date. So, this present value of A plus coupon, what you're trying to compute, A plus coupon value is 952.88. So, now for that 952.88 you have to compute the present value. So, what you do is 952.88 you put as numerator, you divide it by 1 plus the yield. But the yield, till when do you have to compute present value? You are buying on 1st of March. So, how many months are left? March, April, May, June, 4 months. So, you have to compute the present value for 4-month period. So, you have to, that 952.88, you have to bring it forward by 4 months. But 4 months, how will you do? The required YTM is, what is the required YTM? 12% is annual, so 6% is semi-annual. And number of periods, it is 12 by 2, so it is 6%. So, 1 plus 6%. You do 1 plus 6%, which is 12 by 2, power, you bring it forward by 4 months. So, you do 4 by 6. So, what you do? Time remaining until next coupon by total coupon period. So, from March to June, you have 4 months, whereas from Jan to June, that is the total coupon period is 6 months. So, 1 plus 6.06, 1.06 power 4 by 6, which is 952.88 divided by 1.06 power 4 by 6 or power 2 by 3. Okay. So, if it is power 2 by 3, we have showed you a calculator trick. I will show that to you again. If you are given an exam, either they will give the value or you can compute it using calculator trick. So, you compute the present value, you get it as 916. So, 952 brought forward by 4 months is 916. Now, this 916 is what? Present value of this minus accrued interest. 916 is this value minus accrued interest. What is this accrued interest? This accrued interest is accrued interest from Jan till March. So, accrued interest is face value, which is that 1000 rupees. Coupon rate is 10% per annum. So, by 2 because semi-annual coupon, so 10 by 2. Time elapsed is 2 months, so 2 by 6. So, you value the bond till date as on date, and then you are subtracting the accrued interest from the previous interest payment date to the in between date. So, you have now computed 16.67 as the accrued interest from 1st of Jan till 1st of March. So, you subtract from 916, 16 rupees, you get 899.9. Is it? So, you have to slightly think carefully. First, you are valuing the bond just after the payment of coupon, add the coupon value. So, basically, you are valuing the bond on the next coupon date. You are doing present valuing it as on the date of purchase. That present value is computed as divided by 1 plus yield power the number of months to be expired by the total number of months in that coupon payment. So, that is 1.06 power 4 by 6. That will give you value of the bond as on today. However, you subtract the accrued interest, which is from 1st of Jan till 1st of March, that gives you accrued interest. That accrued interest you subtract from this price of the bond. So, basic value of the bond is 899. So, coming back, I am not adding exact numbers, I am taking round numbers. Okay. Basic is 899, accrued interest is 16. So, total is 91915. Okay, I am rounding off, just do not go by the exact numbers, I do not want to get into that logic discussion. So, this is known as clean price, this is known as dirty price. Clean is equal to dirty minus accrued interest, dirty is equal to clean plus accrued interest. That is how we compare. It is a very, very simple topic, it is a very, very simple thing, but people tend to get confused, what should I do when? Just remember this one particular example. If a question comes in the exam, you will be able to do it much, much better. So, friends, now the next aspect that we are going to look about is duration of a bond and convexity of a bond. But before we get into duration and convexity discussion, there is one very important concept which I want to discuss with you, which is very closely linked to duration and which will help you understand the concept of duration better. And the concept is, you have to understand what are the risks that the holder of a bond has, specifically with respect to market price or reinvestment, more so monetary risks that are associated with the bond rather than credit risk or default risk or anything like that. So, a bond holder faces two risks: market price risk and reinvestment risk. So, if you remember the concept of IRR, you would remember or rather recollect that all the inflows that come in between periods are reinvested at the same rate, or rather all outflows are borrowed at the same rate. The interest rate that is applicable even on intermediate cash flows is also the same. What I mean by that is, let us say there is a bond, and this particular bond is, let's say, 5 years, 10% coupon, 100 rupees face value, issue date is 1120x1, today is 1120x1, and this will be till 31/12/20x5 because it's a 5 years bond, and for 10% coupon annual. Right now, face value is 100 and 10% coupon is annual, then basically it means in this kind of scenario, YTM is 10%. Right. Now, what does YTM 10% imply mean? We already discussed, where we said, you discount the cash flow 10 by 1.1 plus 10 by 1.1 whole square, so on and so forth, till 100 by 1.1 power 5. You discount everything, you will get the same 100 rupees is what we discussed. If you do not remember, please go back an hour or so in the video, you will understand that. Now, what is the underlying philosophy in this? Here, this 10 rupees you are getting after the first year, the first coupon payment that you are getting, what will you do with that coupon? Will you keep it in your pocket? Will you put it in bank? If you put it in bank, what rate are you earning? It is assumed in this computation that you are actually earning a rate of same 10%, this 1.10 which reflects 10% interest rate, same yield is earned on even the cash flows that are coming in between, which are reinvested at the same rate. So, this whole thing basically is underlying assumption is all the cash flows are reinvested at 10%. Now, is that genuinely possible? If let's say today you have a bond and you are getting a coupon payment of, let us say, 8 rupees or 9 rupees or 10 rupees in this case, will you be able to reinvest on the day when the coupon comes to you? Will you be able to reinvest it at the same 10% again on the first day? So, let us say you are on 1st Jan and you get the coupon on 31st December. You get 10 rupees coupon. Are you sure that on 31st December you will be able to reinvest that 10 rupees again at same 10% for next 4 years? Interest rates change every day. Interest rates change every day. So, the coupon that you get, you may not be able to reinvest it at the same rate as yield. So, you face a risk called reinvestment risk. You face a risk called market price risk. Now, what is this market price? When there is a change in interest rate, the price of the bond goes up or goes down. And here we are talking about the price of the bond during the period of the life of the bond. At the maturity, you will get the maturity value. But during the period of the bond, let's say interest rates go up. Let me take the opposite way. Interest rates go up substantially. What will happen? Interest rate goes up, bond price comes down. The bond prices come down. You may get a coupon, yield is up and all of that is fine. But on that day, if you were to sell a bond, you will not be able to recover the money of the particular, whatever. You will be able to get only portion of the value of the principal value of the bond. You will be able to recover only a portion of the principal value of the bond. Why? Because yield has gone up, price has gone down. Okay, and this reinvestment risk and this specific reinvestment risk, whatever is there, as well as this market price risk, whatever is there, exists for every kind of a bond. Exists for every kind of a bond. However, there is a way in which you can avoid these two risks. There is a way in which you can avoid these two risks. So, what you can do is, you can buy a bond of some X value, okay, with some special characteristics, such that this bond, when it matures, you get some Y money. This Y money exactly meets your Y liability on a due date. So, just to explain this further, let us say there is in the market there are 5-year bonds, 10-year bonds, 15-year bonds, so on and so forth. However, you have a liability which is exactly 6 years. You have a liability. You have money today, you have a liability that you need to pay after 6 years. Think of it as some PF, pension, gratuity, whatever it is, there is some liability. After 6 years, you have a liability. but you have some money today. So you have an asset today, you have a liability later. Please note these words: asset liability management. This is all part of ALM. Okay, you will learn about this subsequently when we talk about interest rate risk management. Okay, now you have a liability after 6 years and you have some money today. Can you invest this money in a bond? Can you invest this money in one bond or a portfolio of bonds such a way that at the end of 6 years you sell those bonds and the money is able to meet your liability value? After 6 years, you buy a bond today, sell it after 6 years so that your liability value is met. And during this period, even if the interest rate changes, even if the bond price changes because of changes in interest rate, reinvestment risk changes, all of that is taken care of. What is the way in which you can do this? And specifically, there is no 6-year bond. Please note, I specifically designed this question in such a way. There is a 6-year liability, but there is no 6-year bond. So what you will do is, you will create a portfolio whose weighted average of present value of cash flows is equal to tenure of liability. So you will create a bond whose weighted average of the present values of the cash flows is equal to tenure of liability. So you will create a portfolio of bonds whose cash flows, whose present values of cash flows, whose weighted average of the present value of cash flows is exactly equal to 6 years. And if such a thing happens, this whole process is called immunization. It is called immunization. Immunization, where you are trying to immunize a portfolio, or you are trying to what is immunity? Immunity means basically defense against some kind of disease, right? That is what is immunity. Or immunization, basically when you give a vaccine or vaccination, immunization, these are all related terms. The idea is you are protecting yourself. Here you are protecting yourself from market price and reinvestment risk. So what you do, you create a portfolio of bonds which basically has weighted average of the present value of the cash flows of this particular bond portfolio equals exactly this tenure of the liability, 6 years, and the portfolio is automatically immunized. That is, no matter what happens to the change in interest rate, the value of the portfolio after 6 years, when you have to pay the liability, when you sell off that portfolio will give you a value which is equivalent to the liability that you have. So, but this portfolio is of 5-year and 10-year bonds. See, if there is a 6-year bond, you can anyway invest money in the 6-year bond. You can invest money ideally in a 6-year zero coupon bond. Then you don't have any problem. See, imagine you have a zero coupon bond. Currently, the interest rates are, let's say, 10%, and you have a 6-year zero coupon bond. Whatever is your liability, to the value of the liability, exactly matching to the value of the liability, you take the redemption value of zero coupon bonds equivalent to the value of your liability. So their present value will be something. So you invest that present value, it will compound, and on the due date, when the bond matures, you will get the money which will be equivalent to the value of liability. So zero coupon bond is always there. If zero coupon bond is not there, let's say if there is a bond that does not exactly exist for your liability tenure, which is 6 years. Okay. Or if there is a 6-year bond, but in that bond, you get the intermediate interest flows, you get this 10, 10, 10, 10 and then 100. This 10, you'll have to again reinvest, no? You have to assume that for the next 4 years, you have to get the same 10% interest. How will that happen? So, it does not happen in the real world. So, what you will do is, instead of doing this or this, you will rather invest in a portfolio which has the weighted average of present value of cash flows equal to the tenure of the liability. Then you have immunized a portfolio against any changes in market prices or reinvestment risk of the principal if the bond is maturing in before. So, after having understood it from an immunization angle, let us actually see what is duration. Let us look at the definition of duration. Duration is the weighted average time within which an investor gets back the promised principal. It is also a measure of interest rate risk. So, it is a measure of interest rate risk. That is, higher duration implies higher interest rate risk and lower duration implies lower interest rate risk. Following are some of the factors that affect a bond's duration. What are the factors? I explained to you what is duration. Duration is present value of cash flows weighted by time. Yeah, so here the weighted average is based on the time. So it is time weighted average of this particular portfolio's cash flows, portfolio's present value of cash flows is duration. So present value of cash flows into time by P0, sigma of this is formula for duration. So what are the factors that influence duration? Obviously first one is time, second one is cash flow, which is coupon and maturity value, and the present value. How is present value computed? How do you compute the present value factor? By using the yield to maturity, the rate, YTM rate determines it. So higher YTM means lower duration and hence lower interest rate risk, and lower YTM means higher interest rate risk. So the duration, what we have just discussed just now, what I explained to you, is called as Macaulay duration. There is something else known as modified duration. Modified duration is Macaulay duration divided by 1 plus yield by n. The formula for Macaulay duration is this. I explained to you super simply. Sigma of present value of cash flows into time divided by P0. So this can be rewritten as sigma of t into c by 1 plus I power t. So basically you are multiplying the time into the coupon value and you are computing present value of the same way. N is the last year is also time into maturity value and at present value, which is 1 plus I power n, whole thing divided by p. So this is the formula for Macaulay duration, and there is another formula. This is a slightly more complicated formula. I would not use it unless required. And the formula is 1 plus y by y minus 1 plus y plus t into c minus y by c into 1 plus y power t minus 1 plus y. I definitely would not use this because it is more logical for me to understand that duration is sigma of present value factor into coupon value or into cash flow into time divided by P0. Okay, and modified duration is minus Macaulay duration by 1 plus YTM by n. We will get to that. Okay, now let me show a problem to you, and then you will understand this much better. Let us look at the very first problem. This has bunch of other things. We will ignore those Macaulay duration, volatility, convexity, all of that will come later. Let us, or even we can see Macaulay duration but not modified, but not the other aspects. We will come to the other aspects. Let us look at this simple problem. Following data is available for a bond. Face value is 10,000 to be redeemed at par on maturity. Coupon rate is 8.5. Maturity is 5 years. Yield to maturity is 10%. Coupon value is 8.5. and YTM is 10. We don't know when is issue date. We know that from today onwards 5 years maturity is there. Find out the current market price of the bond, find out the Macaulay duration of the bond and volatility of the bond. So you have to find out current price of the bond, Macaulay duration, volatility, convexity. So we will compute the first couple 2 or 3 and then we will get back to the others later. What is the price of the bond? Present value of cash flows, whatever the cash flows. So they have given present value factors at 10% and 8%. And we have yield of 10%, so we will consider 10%. So face value is 10,000. So 8.5%, 10% is 1,000, 8.5% is 850. So 850 into present value factor annuity for 10% for 5 years plus 10,000 into present value factor for 10% for 5th year is what you will use. And using those two, you can actually compute 850 into 3.7n. How do you get 3.7n? Use all these 5 present value factors. Plus 10,000 into 0.621, which is basically the last year's present value factor, you get a price. The price is 9431.5. Now, this price definitely is not on the date of the issue, because on the date of the issue, typically companies will try to ensure that the price of the bond is actually equal to fair value. So they will ensure that the bond is priced in such a way that the coupon is equal to the yield. Now, coming to our aspect of Macaulay duration. Macaulay duration is what? Sigma present value factor into time into cash flow. So you see cash flow is in the column 1. So 5 years, 5 cash flows. Then present value factors for all the 5 years are given. Then you multiply these present value factors with the B and C is equal to D. Basically multiply the present value factor with the cash flow. Then what you do is you can directly multiply this 772.65 into 1, or you can compute weights. This 772 by 9431.5, 702 by 9431, 6737 by 9431, like that. Here we have done as weights. Even if you don't do that way, it is simply multiplication of 771 into 1, 702 into 2, 638 into 3, 580 into 4, 6737 into 5. Or if you compute the weight, you multiply the weight with the time. So either ways you are going to get the same answer. So once you do that, for the coupon values, you get a value of 9053. What is the coupon value? 1 into 850 into 0.909, 2 into 850 into 0.826, 3 into 850 into 0.751, so on and so forth. So coupon value summation is 9053, and then you do for the maturity value 5 into 10,000 divided by 1.1 power 5, you will get 31,000. So Macaulay duration is 9,000 plus 31,000 divided by price of the bond, which is 9431. So you get 4.252 years. You got the same thing here when you computed the proportion of the bond value based on the price. See, because when you compute cash flow into present value, you are basically getting the price. Present value of all cash flows is the price, no, summation of present value. So either that, when you take the ratio of that cash flows contribution to the price and multiply it with the time, you again eventually get the same answer. So don't worry about it. The easiest formula is what I've said, which is, remember, sigma PV into time into cash flow, okay, by P0. Don't forget by P0. So you get 4.252 years. This is known as Macaulay duration. So even though the bond's life is 5 years, where is this? Bond's life is 5 years. Here, even though the bond's life is 5 years, what is evident from this is that this particular bond, time it takes for you to recover the cash flows in present value terms is actually only 4.25 years. So this bond has duration lesser than its maturity. Almost all bonds will have duration less than maturity only. But if they have, let us say, very short duration, then the reinvestment risk is small. If compared to a 4.25 years as duration, if this bond has 4.9 years of duration, then it has higher duration. So basically it has higher interest rate risk. Whereas if it has lower duration, it has lower interest rate risk. Okay, that is one aspect. Okay, now there is something called as volatility of the bond. What is volatility of the bond? So I told you Macaulay duration, then I told you modified duration. So in exam, no, they will not ask you just duration. They will either ask you Macaulay or modified. If they don't say that, you have to understand the question and figure out what is Macaulay, what is they asking. Are they asking Macaulay or modified? Now, typically when they ask for duration, it is usually Macaulay duration. However, when they are asking you in terms of sensitivity of a bond to change in interest rate, bond price to change in interest rate, they are referring to modified duration. If they say, what is the, compute the sensitivity of a bond to change in bonds price to change in interest rates, and what compute the duration. So they both basically mean the same thing. So at that point of time, you are required to compute modified duration. However, they just say this is the bond, this is the price, compute the duration, compute the volatility and all. Then you are supposed to compute, when they say duration, you are referring to Macaulay duration. So sensitivity is of the bond's price to change in interest rate is called as modified duration, or also called as volatility, And I told you the formula, modified duration is minus of Macaulay duration by 1 plus y by n. Here this particular bond does not have multiple coupons in a year, it is only one coupon, annual coupon payment. So here modified duration is going to minus Macaulay duration divided by 1 plus y. So duration is 4.25, Macaulay duration is 4.25 divided by 1 plus y, yield is 10%, so you get 3.865. So 3.865 is the sensitivity. So for a 1% change in the yield, the bond price will change by 3.865%. For a 1% change in yield, the bond price will change by 3.865% in negative direction. So if yield goes up by 1%, this comes down by minus 3.865%. Okay. Now this is modified duration and not Macaulay duration. Macaulay duration is simply the weighted average time it takes for you to recover in present value terms the value of the bond. Whereas modified duration is the sensitivity or volatility for a 1% change. Okay. Now coming back. Modified duration also has this another formula, which is c by y square 1 minus 1 by 1 plus y power n plus n into m minus c by y by 1 plus y whole power n plus 1 by p. I don't remember this formula, boss. It is very simple. Please remember this simple formula, minus Macaulay duration divided by 1 plus y by n. Super simple. You don't have to remember anything. Modified duration is equal to Macaulay duration by minus Macaulay duration by 1 plus y by n. Okay. Now these two give you understanding of what is basically the sensitivity of a bond. How do you compute the change in price of a bond due for a change in interest rate? And immunization is linked to this concept of duration, where I said that the market price risk and the reinvestment risk are offset at a point when duration of a bond portfolio is equal to maturity of the liability that you have. At that point of time, you will offset the risk. Okay, so that is called process of immunization, and that duration is Macaulay duration. Now coming to the next part, something called convexity. Now before you understand convexity, we have to come back to understand something more specific with respect to a price of a bond. So this is the bond price curve. Okay, so this is yield, this is price. Okay, now this is the relationship between price and yield. Yield is always on x-axis and price is on y-axis. Now what you have to understand is, this is not a straight line. So what if it is not a straight line? There is a very important aspect. Now if let us say this is yield 0. So there is this initial point called y0. Now you have another point here and you have another point here. This is y0 plus delta y and this is y0 minus delta y. Right, these two points, the price is different. These 2 points, the price is different. Now when the price is different, now one more very, very important thing that you should note is this curve, this particular curve, this particular curve is convex in nature, So what happens is, for same level of movement, the price for this level of movement, there is a change in price of this much. Whereas for this level of movement on the other side, same delta y, there is a change in price of this much. So for a small same delta change, when you do plus, you are getting a different change. When you do minus, you are getting a different change. Hope you have understood. What I mean is, I have 10%. So if I add 1%, I'll get 11%, and if I subtract 1%, I'll get 9%. If let's say this price, when the yield is 10%, let's say the price of the bond is 1000. For a 1% increase, the bond price comes down only to 990. Whereas for a 1% decrease, the bond price goes up to 1050. So for same 1%, here the impact is 10 rupees, here the impact is 50 rupees. And these are my made up numbers. I am not actually computing them. Okay, we will compute in one of the problems. But the broad idea is this: for same change, the impact on the price of the bond is different. Same percentage, same absolute value change in the yield. For same delta y, if it is plus delta y, it is decreasing by 10 rupees. If it is minus delta y, it is increasing by 50 rupees. Okay, so this is the nature of the curve. Why is the curve like that? The curve is like that because we have the equation 1 by 1 plus I power 1, c by 1 plus I power n, c by 1 plus I power whole square plus c by 1 plus I whole cube, so on and so forth. This is the present value formula, right? In present value formula, if you add, let's say 1 by 1 plus 10%, you compute 1 by 1 point, which is 1.1.1, right? You compute 1 by 1.11 versus 1 by 1.09. You are adding same 0.01 on either side. Okay, plus 0.01 minus 0.01. So what is the value? 1 by 1.1 is how much? 0.90909. 1 by 1.09 is how much? 0.91743. And let me subtract this 0.9090909 from this. You will get the change is 0.008340. Okay. Whereas what is 1 by 1.11 is 0.9009009. So what is the change? Minus 0.909090909. Change is 0.00819000. So when you have increased the rate, see here, when you have increased the rate, came down only by 10 rupees. It came down from 0.909, it came down to 0.9009. So, it came down by 0.008. Whereas, when you decrease the rate, it went up by 50 rupees. So, when you decrease the rate, it went up by a higher value, 0.00834. So, 0.0081 versus 0.0083. You see that point? This change is very different when you divide it by a factor. When you add a number to the denominator versus when you subtract a number to the denominator, the impact on the absolute value that comes out, or the impact on the outcome is very different when you add versus when you subtract. So, this leads to two things. One is the fact that when you add interest rate, the price is different. When you subtract interest rate, price is different. Price is obviously different, but the change in price is very different, right? So, there is a very different change in the price. So, what it means is, when you have the P0 is equal to present value of cash flows, correct? If you go back to your derivatives chapter, not this derivatives, not put, call, option, forward, future, I am referring to mathematics, derivative, calculus, differentiation chapter, where P0 is equal to sigma cash flow present value. Okay. What is the change in price delta P0 when there is a small change in interest rate? So, here there is a change which leads to a change here. So, when there is this small change, what is the change here? So, how do you do it? How do you compute this? This change is computed by differentiating this equation. What is this equation? C by 1 plus I whole power 1 plus C by 1 plus I whole power 2 plus C by so on and so forth, M by 1 plus I whole power n. You are differentiating this equation with respect to I. When you are differentiating this equation with respect to I, you get for a small percentage change in I, what is the impact on P0? But the differentiation assumes that, differentiation assumes a linear relationship. Whereas the price is a curve, it's a convex curve. So, when you do differentiation for that one small, and it applies for very, very small changes. For very small changes, you probably get an approximately right value along the curve. So, let us take this scenario, like this. This is the curve. This is the curve of the bond price curve. For a small change from here to here or here, you may get values which lie on the line but are also very close to the curve. Why? When you do differentiation, you basically get a linear equation. That's all. Linear means line. So, you may get values on the line which are close to the curve. But when you do slightly bigger changes of interest rate, you get a value here or a here which is very, very different from the actual price depicted by the curve. So, what happens? When you do this particular differentiation, you are basically getting modified duration. If you remember the formula, what did I tell you? Modified duration is the change in the price of the bond for a percentage change in the interest rate. Correct. That is what I told you. Modified duration is minus MEC duration divided by 1 plus y. That is basically sensitivity. That is basically volatility. This is what I told you. So, this differentiation when you do to the equation which depicts the price of the bond, you basically get this modified duration, which is minus Macaulay duration by 1 plus y. That number does not depict the exact value of the curve. That number does not give you the exact value on the curve, on the curve. It gives a value on the line. The line is not an actual price. The price of the bond does not fall on a line. The price of the bond is on a curve. And we discuss this. And the curve also, the change in price is very different for a decrease in interest rate versus an increase in interest rate, or decrease in yield versus increase in yield. For an increase, it falls by a smaller amount. For a decrease, it goes up by a larger amount. Right. Now, given this understanding, these are all essential for you to understand what? Understand the next step, which is the thing called convexity. Convexity. Volatility or sensitivity is your modified duration, and convexity is the second order differentiation. So, basically, you have differentiated it first time, d by dx. You are doing d by dx of again of this, second order differentiation of this. So then you basically get something called as convexity. Again, convexity is also not an exact number. Convexity will, instead of giving you a curve like this, it accounts for a large portion of this gap. But if you want to know the exact price, please substitute the number in the formula, in this formula. If you want the exact price for a change in yield, please reprice it using the formula. However, if you want an instantaneous, quick and dirty answer, use either this, use this modified duration or use this convexity formula. What is this convexity formula? We will discuss. So, what is this convexity? As I explained. So, what is this convexity formula? You have this formula where convexity is C star. C star is V plus V minus 2V by V0 into delta Y square, and this is C star. This C star is again multiplied by sigma delta Y square by 2 into 100. Now, this is very complicated to understand from a formulaic perspective. Let me explain. So, what happens is, initially when I discussed Y delta Y plus Y minus delta Y. There are these three prices. Now, this is called, this particular value is called V plus, that is when yield increases, what is the value? This particular value is called V minus, that is when yield decreases, what is the value? And this particular value is called V0. So, what you are basically trying to do at this particular point is try and figure out the gap, this particular gap. This particular gap. You are trying to figure out the value for this particular gap, because first derivative gives you the value, which basically is your modified duration, gives you for small changes. To that you have to add the impact of this convexity, and this convexity formula, how do you make the adjustment for convexity? C star is equal to basically your V plus and V minus, basically both the values, minus 2V0 divided by V0 into delta Y whole square. So, this is the formula which gives you the value of the convexity. But this convexity is not directly the exact impact. You have to again do something else. This is just the value of C star. What is the value of convexity, or the adjustment that you have to do for convexity is this: C star into delta Y square by 2 into 100. Now, this gives you the, when you do this entire exercise, this gives you the exact, so this is purely the convexity event, and this is the element where you do the convexity for a change in yield. Here, because you are doing the second derivative, see, this convexity value also is appearing for both the plus and minus you have computed. So, you are dividing it by 2 to get the value for one side. Then, because this is second order change and the change is in terms of percentage change of yield, you are multiplying it by the percentage change in yield whole square and into 100. Into 100 is to bring out the fact that this delta Y is basically percentage. So, you are converting that into numeric. This will give you the change in price. But again, this change in price is only the convexity effect. So, if you have to find out in a particular bond price, if let us say bond price currently 8%, if it is changed to 10%, the price is 100. What is the price if it is changed to 10%? One way is obviously you can compute C by 8 by 1 plus 8% power 1, so on and so forth. Instead of doing all of that, you can take duration impact plus convexity impact, which is what is duration? Duration is, here duration refers to modified duration. So, minus Macaulay by 1 plus y minus Macaulay duration by 1 plus y, which is what you get as modified duration, into the change in yield, because this is for generally percentage change, but you have to figure out, this is a generic formula for 1%. You have to actually see for how many, what is the exact change in yield that you are looking for. Then you also have to add, and here please note it is add the value that we have computed here, which is C star into 1 by 2 into delta y whole square into 100. Okay. Now, in some cases they do this by 2 here, in which case they remove it here. Some cases, what I did, you do by 2 here only. Okay. My preference is doing by 2 here rather than doing by 2 here. Okay. So, change in price delta P is equal to minus Macaulay duration by 1 plus 5 or minus modified duration into delta y, right. Modified duration is 1 plus Macaulay duration by 1 plus 5, right, plus C star. And please note, it is not minus, it is, you take minus only once. When you compute duration, sometimes when you show it, even if it's shown as a negative number, so it is not double minus, it is only single minus. Either you take minus Macaulay duration or you take, after you compute the duration, you put minus. It is not minus of minus, it is only 1 minus. Okay, C star into half into delta y whole square into 100. So, this will give you the impact of the change in price. How much is the percentage change in price? And please note, this is percentage change in price for a percentage change in yield. So, you will not exactly get 100. If you do all of this, you will get a value of 2%. So, 100 minus 2%. So, which is 98. Why? Because yield has gone up, price will fall down. Okay. So, that is how you compute. Having understood this, now let us come back to the problem what we were solving earlier. What is the problem that we were looking at earlier? Yes, in this question they said compute the volatility, which is your modified duration, compute the convexity of the bond, compute the convexity. What is convexity here? Convexity, exactly this. And here please note, I used by 2 here, so it will not come in the second part. So, convexity is equal to convexity, you find out, they have asked you to find out the convexity. Okay. So, you need not find out the change in the price of the bond. Here they have asked you to just find out convexity. So, what you do is, so you reprice the bond at 8%, right, and you reprice the bond at 12%. See, even though you have computed the value at 10%, you can use that also. That is not an issue. But I am in this problem, I have done it 8 and 12, you can do 8 and 10. What are the rates that they have given? They have given 8 and 10. If you want to try, you can try it 8 and 10 also, it does not matter, right. So, for a 8% yield, the price has gone up. For a 12% yield, the price has gone down. Now, what is the convexity? Convexity here is whatever is the decreased price plus increased price minus 2 into original price 10%. See, that is why they have taken 12%. That is why they have taken 12%, because you need 3 prices here: V0, V plus and V minus. So, V0 is 10%, V plus is where the yield is added, which is 12%, V minus is where yield is subtracted, is 8%. So, V0, V plus, V minus, you have computed these 3. So, these 3 are taken here, V1, V plus V minus 2 into V0 divided by 2 into V0 into delta y square. And see, you please note, both the places we have taken 10 plus 2 and 10 minus 2. So, V0 is 10. So, plus 2 and minus 2. You have basically done plus 2% minus 2%. So, whole square. So, you get a convexity adjustment factor of 9.8. That is not convexity. Convexity is C star 9.867 into delta y square, which is again the 0.02 whole square into 100. So, you get 0.395%. So, 0.395%. So, based on this computation, the convexity value is 0.395%, right. Now, what is the next question that they have asked? Expected market price if there is a decrease in YTM by 200 basis points by Macaulay duration method and intrinsic value method. Macaulay duration is only first change, not the second change of convexity, but they are asking only the first derivative, Macaulay duration. What is the Macaulay duration? We found out the Macaulay duration where Macaulay duration is 4.23, but you don't compute a change due to Macaulay duration, you compute it by modified duration. So, this part is wrong. So, this is not Macaulay, this is modified. This is modified duration. Okay, that is a question, mistake in the question. So, by modified duration, you take 9431, which is the current price at what? At 10%. Then, what did I tell you? I gave you a formula here, minus modified duration into delta y. So, minus modified without accounting for convexity. So, modified duration into delta y. What is modified duration? 3.865. So what you get is minus 3.865, which is basically your modified duration, into delta y. What is the change? Is the change increase or decrease? It is a decrease. So minus 2% into 100. You will get a value. What is this value? 2 into 3.865. That is 7.73. 7.73% is the change in price. And because you multiplied minus into minus, you get plus. Why is it a plus? Because when the yield decreases, price increases. So your old price 9431.50 into 7.73%. You get a value of 729.05. So the price has increased by 729.05 to get 10160.55. However, we have taken only the duration impact. What about the impact of convexity? We have not taken because they have not asked in the question. If they ask in the question, what will you do? You already have the convexity value. What is the convexity value here? We have found out a convexity value, 0.395%. So what is the formula for convexity related stuff? Here is the formula. You've already got convexity of 0.395. So because of convexity, what is the change? 0.395% of what? 9431.5. So 9431.5 into 0.395% is how much? Is equal to 37.25. What was the change that we got? 729.05 because of duration. This is because of convexity. What is the total number? Plus 729.05. You get 766.30. You add that to original price of 9431.5. What you get is 10197.80. 10197. Please note, here what is the price that we got? 10160. How did you get 10160? You added 9431.5 into 7.73 plus 9431. So you got 729, you added it 10160. This changed to 10197.8. However, if you do by intrinsic, it is 10204. Why? Because we already computed by 10205. So duration gives you a rough estimate, convexity gives you a closer estimate, repricing the bonds give you the exact number. Okay, this is something that you have to remember. Now, in this question, they didn't ask for computing the price using convexity. They said compute using Macaulay, which is wrong. You should do using modified duration and also, of course, intrinsic value. Okay, they have asked this kind of question multiple times in the exam, and I have solved this question right up front when we are discussing the concept, just because it is going to be fresh in your mind. Okay, we will probably see a couple of more questions like this, but I want you to remember this particular question very, very well, because this kind of question has been repeated multiple times in the exam. Okay, now let us move to the next aspect in this particular chapter. What is that? We have completed most of the major things. Let us look at the other aspects. All these we have discussed. Bond risks and credit ratings, immunization. Immunization, I have already explained this to you well before, because it was making more sense there. Price risk and reinvestment risk, both the risks you are trying to counter. Then you have something called as yield curve. So please note, I have told you that is the curve depicting the price yield relationship is very different from a yield curve. I wanted you to note that. Then term structure theories and valuation of debentures and warrants. So let us look at the next aspect, which basically is bonds, risks and credit ratings. Okay, there is a small topic on positive and negative convexity. It is not there in the syllabus. I have explained it in the main course. I don't want to explain it. Normal convexity is called positive convexity. There is something called negative convexity when the bond has a call option. Okay, so I am not going to spend time on it at all. Okay, now bond risks and credit rating. What are the various risks associated with bonds? One is default risk, that the company defaults. Inflation risk. The inflation must be much higher than the coupon rate. So the coupon that you have, its value will be less in the market when you go out and buy goods than what the monetary value is. Reinvestment, that coupons may not get reinvested at similar rate. We discussed about this. Call risk, there is a risk that the bond issuer will call back the bond because interest rates have come down. Sovereign risk, that the adverse events in bonds country may affect the bond prices. That is basically issue of political or geopolitical issues. Interest rate risk, that the Bond price shall fluctuate based on change in interest rates, which is normal. Liquidity risk, that the bond may not sell quickly at an efficient price. The bond, you may not be able to sell the bond. There is very few people willing to buy or sell. Right. What are credit ratings we discussed? It is a way to measure the credit worthiness, and different factors are considered in credit ratings: issuers, financial strength, proceeds, use of proceeds, global economic industry and company analysis, tenure of the bond, and their price in market after considering bond ratings associated with them. Bond ratings are issued by CRISIL, ICRA, CARE, Moody, Fitch, SAP, so on and so forth. Then we discussed about immunization. Then we need to discuss something called yield curve. What is a yield curve? A yield curve, unlike a price to yield relationship, in here the yield is on y-axis and tenure is on x-axis. Here, as the tenure increases, typically the yields increase. That is, if I am asking you for a long-term loan, you will ask for higher interest rate. But in some cases, the yields may be downward sloping. That is, when there is very immediate, very severe shortage of liquidity in the short term rates may be high and long-term rates may be low. So, it is called as an inverted yield curve. It is called as inverted yield curve. Short-term rates are high, long-term rates are low. Then you have something called as flat yield curve. It doesn't matter what the tenure of the bond is, always the rate is same. Then you have something called as humped. So, short term low rates, medium term slightly high, long term again low rates, right. So based on these, you have to look at certain things. There is something called as a spot rate, there is something called as a forward rate, and you arrive at these forward rates by bootstrapping. So, this whole process is called bootstrapping, or it is also called as term structure of interest rates. Where is this? Term structure of interest rates. It's also called bootstrapping or term structure. How you arrive that is, let us look at this example. There is a bond and all three bonds have same credit rating. All three bonds are of similar kind of industry, everything. 1 year bond, face value is 1000, market price is 950, YTM is 5.26. Assume that these are zero coupon bonds. Assume that there is no coupon. Okay, assume that there is no coupon. Even with a coupon we can compute, but I am taking simplistic example. 2 year bond, 1000 rupees face value, current market price is 875, YTM is 6.9. What is YTM? YTM is basically the spot rate. The rate that you will ask if someone were to want to borrow from you for a 2 year period. Okay, then 3 year bond, 1000 rupees, current market price 725 and yield to maturity 11.32. So, how did you get this 5.26? When the price is 950, you divide 1000 by 1 plus R, and with the 950 is the price, you solve for R, you get the value of R as 5.26. For 875, this is the price is 875. 2 year rate is 6.9, that is from year 0 to year 1 6.9, year 1 to year 2 6.9, right. But we already know for year 1 it is 5.26. We have just computed for year 1 it is 5.26 because it's the same kind of company or same company, same credit rating, everything is same, so the rates will not differ. They will differ only if the period is different. So, for 1 year if it is 5.26 and for 2 full years it is 6.9. But so, for first year it is 5.26. What is it from end of year 1 to year 2? So, I will explain this much better. You have two kinds of loans. First is year 1, year 0 to year 1, one rate, year 1 to year 2, another rate. Second one is year 0 to year 2, same rate. Now, this, if you compound using these rates, you eventually get same 1000. For both of them, initial price is 875. But here you are multiplying with two different rates, you are multiplying with the same rate compounded 2 times. So, okay. So, I will further explain this in even simpler manner. You have 1 plus S1 whole square, which is same rate applicable for both years. Principal into this or current value into this is same as current value into 1 plus S0, that is first year's rate, plus 1 plus some other number called Y2. Now, this S0 is spot rate This S0 is spot rate for 2 years. This is a 2-year rate, right, which we got as some 6.9% or something. Here, first year is 5.26%. So, what is this rate for, this is 0 to 1, this is 1 to 2. So, what is this rate for 1 to 2? This is called as forward rate for year 1 to 2. You use 2 interest rates to figure out the third interest rate. So, you use the 0 to 2 rate and the 0 to 1 rate to arrive at 1 to 2 rate. That is what we have done. So, you see here what have we done? 875 is equal to 1000 by 1.0526 into 1 plus F2. F2 is forward rate from year 1 to year 2. So, you get F2 as 8.5%. Same way, to get the forward rate for year 3, what you do is 725, which is the price, and 11.32 is 3-year rate. So, 725 is equal to 1000 by first year rate of 0.526, second year rate of 0.85 and 1 plus F3. You solve for F3, you get 20%. Now, if you look at these rates, for 1 year, the interest rate is 5%. For 2 years, for basically from year 1 to year 2, it is 8.5. Year 2 to year 3, it is 20. Year 3 to year 4, it is some other number. So, this is how you plot forward rates. You do bootstrapping, or you use the term structure of interest rates to figure out what are the forward rates. Now, after understanding this, let us see what are these term structure theories. What determines these interest rates? You have something called as an expectation theory, liquidity preference theory, preferred habitat, or market segmentation theory. Expectation theory is, as per this theory, long-term interest rates can be used to forecast short-term rates in future, as long-term interest rates are assumed to be unbiased estimate of short-term interest. So, basically what we did, you have 2-year rate, 3-year rate. From 3-year rate, you subtract 2 year, you get the 2 to 3-year rate. Liquidity preference theory, and in this theory, basically long term are unbiased, short term have to be arrived at using long term. Liquidity preference theory, as per this theory, investors are risk averse, hence they want premium for taking risk. Long term bonds have higher rates because of higher maturity and they should have a premium. Further, people prefer liquidity if they're forced to sacrifice the same for longer period, they need higher compensation. Hence, as per this theory, normal shape of the yield curve is positively sloped, that is upward slope. So, if you're long term, you want more, you're taking more risk and hence more interest rate. Then preferred habitat. What is preferred habitat? This theory states that different investors have different preferences. Some want long, some want short. Interest rate structure depends on demand and supply. If whenever there is a high demand for long term, the long term rates go up. Whenever there is high demand for short term rates go up. In case there is a mismatch between demand and supply, investors of a particular segment should be compensated at a higher rate to pull them out from the preferred habitat, hence determining the shape of the yield curve. So, depending on the demand and supply, the yield curve shape is arrived at. Market segmentation theory. This theory states that market for bonds is segmented based on maturity and each segment is independent of the other. Short-term bonds and long-term bonds are not related. So, this is another theory which says both of them are different kind of setup. Right. So, these are various theories based on, which theories that have been propounded, which try to explain to some extent how interest rates for short-term and long-term are determined, how spot rates influence forward rates, or do they influence at all or not. Okay, so these are broadly the theories that we have, and let us go and finish off certain problems before we come to the last part of this chapter, which is on conversion, T-bills, repo and all of that. Those are all much easier aspects. This whole point about your price of a bond, duration, first is Macaulay, then modified, then convexity, then your term structure of interest rate. This is the most important part of this particular chapter. Now, let us go and solve some particular problems. So, friends, now let us look at a problem. Whatever we have understood so far based on duration, convexity, then yield, bootstrapping of yield, term structure of interest rates, a bunch of concepts we have learned. Let us go and look at a few problems on that. First one, the following data are available for 3 bonds A, B and C, and these bonds are used by a bond portfolio manager to fund an outflow schedule in 6 years. So, the outflow is after 6 years. Current yield is 9% and the bonds all have face value of 100 each and will be redeemed at par. Interest is payable annually. There are 3 bonds A, B and C. Maturity is 10 years, 8 years and 5 years. Coupon rate is 10%, 11%, 9%, whereas the current yield is 9%. Okay. Calculate the duration of each bond. We can do that. The bond portfolio manager has been asked to keep 45% of the portfolio money in bond A. Calculate the percentage of money to be invested in bond B and C that need to be purchased to immunize the portfolio. So, this is about the immunization concept. What is immunization? A portfolio is said to be immunized when the duration of the portfolio matches the exact maturity of the liability. When is the liability here? Outflow is scheduled in 6 years. So outflow is scheduled in 6 years. So 6 years is the liability. So we have to ensure that the duration of the portfolio is 6 years by putting some weights for B and C, which is roughly B plus C is 55%. So we have to figure out the weights based on the durations and then compute the answer. After the portfolio has been formulated, an interest rate change occurs, increasing the yield to 11%. The new duration of these bonds are bond A is 7.15%, bond B is 6.03 and bond C is 4.27. Is the portfolio still immunized? Why or why not? Determine the new percentage of B and C of bonds that are needed to immunize the portfolio, with bond A remaining 45% of the portfolio. So what they are saying here is this pertains to this point. So first find out the duration. For those durations, find out the ratios in which the stocks B and C have to be there, so that the average duration is 6. Then there is a change in durations because of change in interest rate. So now find the revised ratios. That is what it is. So what is duration? Sigma, present value, cash flow and time. All these three things by P0. Okay. So bond A, what is it? It's a 10-year bond. Bah, these are 10-year bonds. Pain. 8-year bond, 5-year bond. So that is a nuisance value with this. 10, 10, 10, 10, 10, so on. It's every year cash flow is 10 because coupon is 10. They have, when they have not mentioned what the coupon is, it is fair to assume that the coupon is annual coupon. Okay. Interest is payable annually. Here they have mentioned, so no problem. But otherwise, please mention it as annual coupon and go ahead and solve the problem. So every year you have 10 and the last year you have 110. You find out present value at the current yield, which is current yield of 9%. The coupon rate is just for computing the coupon value. So you get the present value. Duration is present value, cash flow into time. So you have to A into B into C. So you multiply these two numbers, which is cash flow into present value factor. You also multiply with time, which is 1, 2, 3, 4, 5. Then you get this column. Whatever is this column, last column you get the data, you sum it up, you get 730 as a value. 730 is the numerator, which basically is this part. Then you also have to get the denominator, which is the price. What is the price? Price, because face value is 100, yield has come down, price will go up. Price will go up to what? It will go up above 100. So what is the price? Price is the sum of all these discount present value factors or the discount rates, whatever you have, present value factors into 10, because each year coupon flow of 10 plus the last year's present value factor multiplied by 100. So you get price as 106.41. So the answer, or rather duration, is the numerator 730, denominator 106, you get 6.86 years. So you get duration of the bond A as 6.86. Same way you compute the duration of bond B, where the cash flow is 11 per year, present value factor is 9%, then you compute the numerator part, which is 648, divided by the price of the bond 111, you get the duration as 5.835. And same way for bond C, you get duration as 4.28. Now coming to the next part of the question. What is the next part of the question? They have said that the portfolio has to be immunized, which is the liability is 6 years. So the portfolio duration of these three put together should also be 6. Right. Now, if this has to be 6 and they have already said weight of A is 45. So, 6.86 what we got here is 45%, and please note duration is additive and duration is simple weighted average, you can add it. Right. So, 5.84, 6.86 and 4.24. Let us assume the weight of B in the portfolio, weight of the bond B in portfolio is B, then weight of bond C is 55% minus B. How did I get 55%? 1 minus 45%, which is A, is 55. 55 is the balance of B plus C. The duration of bond B is small b, then duration of bond C is 55% minus B. Now, target duration is 6 years. So, what you do? You do simply 6.86 into 0.45, 5.83 into B plus 4.24 into 0.55 minus B is equal to 6, and you solve for B. Then you get the value of B as 36.54. If B is 36.54, which is duration of bond B, then duration of bond C is 55 minus 36.54, which is 18.46. So, you basically get these three as the weights: 18.46, 36.44 and 4. You have what is the ratio? 45. So, these are the three weights of bonds A, B and C in the portfolio, such that the weighted average duration is 6 years, which means the duration of the liability is 6 years, and hence the portfolio is immunized. Now, what have they said? They have said in second case, this particular durations have changed. What have they said? The duration is changed by how much? After the portfolio has been formulated, interest rate change occurs, increasing the yield to 11%. So, from 9, yield has gone up to 11. The new duration of the portfolio are 7.15, 6.03 and 4.27. So, what basically happens is, you've taken the revised duration, multiply by the weights, existing weights, you get a weighted average duration which is 6.20 years. Now, this 6.20 is greater than your 6, right? So, is the portfolio immunized? Portfolio is not immunized. Now, one aspect that all of you have to remember from a practical life perspective or real life perspective is, this duration will change whenever there is a change in interest rate. Exactly what we have seen in this case. So, if interest rates are continuously changing, it means that you have to be continuously changing the weights of your portfolio, bonds in the portfolio such that the duration is matching. You cannot say, I have immunized once and that immunization will stay forever till the end of the life of, or till the time my liability is there. No, it doesn't work that way. All these are one-time changes. So, if you immunize a portfolio, it is immunized for one change in interest rate. If there is small minor changes, no need to bother. But if there are large changes, you have to constantly keep changing the weights of the portfolio. So, which is exactly what is happening here. So, they've asked why has it happened. So, duration of portfolio has increased as the duration of individual bonds has increased, hence portfolio is not immunized as the portfolio duration is 6.2 years versus maturity requirement of 6 years. Now, what is the revised weights of the B and C such that the portfolio duration is now 6? Again, you solve the same thing. 45 B and 55 minus B, you compute the weighted average duration, you get it as 5.566 plus 1.76 B. You equate that to 6 years and solve for B, you get the weights as 24.66 and 30.34. So, you undertake the same process. Now, the weights have increased to what? Earlier, it was 36, B has now become 24. Earlier, C was 18, now it has become 30. So, the weight of a short tenure bond, C is what? C is a short tenure low interest rate bond, that has actually increased and a long tenure bond has decreased. Okay, so this is how you solve a problem like this. Very interesting question with good practical implications as well. Now, let us move to the next question. Please note, my friends, all these questions are available as part of the compiler that I have given free of cost, available on my website. It is also available for you to download as the download link is available as part of the description of this particular video. So, everything that I am using here in the classes, these revision classes can be downloaded directly from my website. Formula sheet, compiler, theory compiler, everything. Okay, we will come back to question number 3 because that's a question that is linked to conversion. We have not yet discussed about conversion, we will come back to it. Let us look at the other problems. And these problems also I am taking from this location where I have given the list of important questions for exam. So, I have highlighted all of these. We have so far finished 1, we have finished 2 and I have said 3 we will do later. Let us come back and look at this problem. This list of problems which links to my compiler is also available as part of the description in my video. Okay. Now, let us look at question number 8. Ms. Agfa Industries is planning to issue a debenture series on the following terms. Face value 100, maturity is 10 years, yearly coupon rate, first 4 years 9%, next 3 years is 10%, last 2 years 14%. The current market rate on similar debentures is 15. So, why this is YTM. The company proposed to price the issue in such a way that it can yield 16% compound rate of return to the investors. The company also proposes to redeem the debentures at 5% premium on maturity, determine the issue price. So, you have to, yield is already given at 16, even though similar debentures are 15, because of the complications that this particular debenture has, they are planning to price it at 16 and they are also going to redeem at a premium of 5 rupees. 5%, which is 5 rupees, 100 by 5% is 5 rupees and the last 2 years coupon is 14%. So, last 2 years is 14, first 4 years is 9, next 4 years is 10, first 4 years only 9, first 4 years 9, next 4 years 10, last 2 years is 14. So, you list all the cash flows here, then you take the present value at 16%. See, please note the present value is at 16. The coupons are different. Present value factor, discount factor, the rate at which you are finding out the IRR or the yield or the YTM, no matter what language, what term you use, it is fixed at 16%. Why? Because the company wishes to price the issue at 16%. So, you get the present value factor, multiply the present value factor with the cash flow and do a sum, you get 71 rupees. So, the answer is debenture should be priced at 71 rupees. Theoretically, if the yield is 16 and coupon is also 16, the face value is the issue price. In our case, that is not the scenario, and hence the price is lower than face value. Let us look at next question. In this 10 also will come back because this is a question related to some amount of concepts that we have not learned so far, which is annualized yield and all that. We'll learn that. It is not complex, very simple. But just that I want to do it together so that there is a sense of continuity. Next, let us look at this question. Question number 13. The following data are available for a bond. Face value is 1000, coupon rate is 16%, years to maturity is 6, redemption value is 1000. So, basically same thing. Yield to maturity is 17. Calculate the duration and volatility. Volatility is what? I told you, Macaulay duration is weighted average years. Sensitivity is known as volatility. In the previous problem, what we found out, where we are trying to do immunize a portfolio, we are doing it with the Macaulay duration. When we talk about volatility, we are talking about modified duration. Okay, and here this duration is Macaulay and this volatility is modified. Very simple. Calculate the expected market price if there is an increase in required yield by 75 basis points. So, there is an increase in yield by 75 bips. So, what does modified duration talk about? For 1% change in the yield, what is the change in the price on an approximate basis, not exact basis. So, first derivative basically. So, using the 75 basis points change in the yield, what will be the change in price in percentage terms and absolute terms. So, first, we are asked to calculate duration and volatility of this particular bond. Even though coupon rate is 16, yield is 17. So, obviously, price is not going to be same 1000. So, we have to first find out the price. So, 6,000 rupees is the face value, 16% is the coupon. So, 160 rupees is the every yearly coupon payment. 6 years. So, you compute the present value annuity factor for 17% for 6 years and present value interest factor for 17% 6 years on 1000. Multiply them. You get a price of the bond as 964. Once you get the price of the bond, you are supposed to compute the duration. Duration is Macaulay duration. Macaulay duration is present value into cash flow into your time. So, you do this into this into this and divide it by P0, which is 964. Okay. So, you compute the duration of the bond, you get the duration of the bond as 4.243 years. Now, this 4.243 years is the Macaulay duration. How do you find out modified duration? Modified duration is normal Macaulay duration divided by 1 plus YTM, which is 3.63. Now, YTM is 17%, so 1 by 1.17, 3.63. Now, I don't think they've answered this question. Calculate the duration volatility of this bond. Calculate the expected market price if increase in required yield is by 75 basis points. So, if delta Y is equal to 0.75%, then delta P is equal to 0.75% into 3.63, which is 2.7225%, but this is minus. So, why? Because they say there is an increase in yield. So, price decreases. Price decreases by minus 2.7225. So, you compute 964.4 into 2.7225%. You get 26.25. You subtract, you get 938.14421. That is the price. This is the price because of increase in yield. Okay, coming next, let us move to the next question. Next question that I have highlighted. I have pre-highlighted all these questions so that we need not waste time. Excel Ispat Limited has made an issue of 14% NCD on Jan 1st, 2007. These debentures have a face value of 100 and is currently traded in the market at a price of 90. Interest on these NCDs will be paid through post-dated checks dated June 30th and December 31st. Interest payments for the first 3 years will be paid in advance through post-dated checks, while for the last 2 years, post-dated checks will be issued the third year. So, basically, it doesn't matter when the checks are issued, you are paying. The bond is redeemable at par on 31st of December 2011 at the end of 5 years. So, on 2007 it is issued. So, 7, 8, 9, 10, 11, 5 years. Correct. Everything is proper. You are required to estimate the current yield and YTM of the bond. See, market price is given at 90, face value is 100, 14% is a coupon and the payment is half yearly. So, current yield and YTM. So, first current yield, if you remember the formula, I told you it as coupon by price. So, what is a coupon? Coupon is 7 because 14% is for full year, whereas it is paid half yearly, semi-annual. So, 7 by price of 90. Then you also have to multiply it by 12 by 6 because the yield that you get is actually for half year, which is 7.77%, you multiply it twice, you get 15.55. Okay, this is the first part of the question. Second part of the question, YTM can be determined. How do you determine YTM? You already have the price at 90. That is what they've asked, no? Determine the YTM. How will you determine YTM? You already have the price as 90. So let us take two values of YTM and price is lower, no? So if the price is lower, it means interest rate is higher than expected. If it is higher than expected, 14% is annual. So semi-annual is 7%. So if it is 7%, let us take higher than 7. Let us take 8 and 9 or 7.5 and 9 or some numbers like that. So in this case, I have taken 7.5 and 9. So if you take 7.5 as the yield, if you do it with minus 90 and if you take minus 90 as the outflow and all the subsequent future payments as inflows, you get NPV as 6.56. Same way, when you do it at 9%, you get minus 2.888. So it lies somewhere between these two. So you do the interpolation exercise. What is interpolation exercise? Interpolation exercise is you have to make the desired NPV as 0. Right, desired NPV is to be 0. So 6.56, let us use 6.56, 6.56 minus 0 divided by 6.56 minus of minus 2.88. So you get if you remember the formula, NPV of low rate minus NPV desired by NPV low rate minus NPV high rate, plus whole thing into high rate minus low rate plus the low rate. So when I say the formula, no, it looks very complex. Ignore all of this. Basic simple logic that you have to remember, which I typically use, is this. For a 1.5% change, the total change in this NPV is 9.388 or 9.438 or 448, something like that. So 448, 9.448. For a 1.5% change, the NPV is changing 9.448. How much percentage should it change so that the NPV is now changes to 6.568, so that the 6.568 get negated. So you compute it and you add it to 7.5%, you get desired rate as 8.5, or the rate at which NPV becomes 0 is 8.54%. Now what is that is the first question. Estimate current yield and YTM of the bond. What are we now looking at? Calculate the duration of the NCD. How will you compute the duration? Duration is using this 8.54. So you take present value of cash flow into present value factor into cash flows into time and compute it and divide it by P0, or take the proportion of the value of the bond by total value of the bond. You get 7.36 years. But 7.36 is for a 5 years of payments, which are 10 payments. So actual duration of the bond is 3.683 years. It is not 7 years, it is 3 years. This you should not forget. If you forget this in exam, marks are gone. Now what is realized yield? Realized yield, that is the next part of the question, right? Assuming the intermediate coupon payments are not available for investment, calculate the realized yield. What is this whole realized yield story? Those coupon payments you cannot reinvest. So what is the value of coupons that you will receive? 10 coupons of 7 rupees plus 100, which is the maturity value. Both of them you will receive. Because you are not reinvesting the coupons, the money lies as it is. So that is a total inflow. Total inflow will be 170. So the numerator is 170 and denominator is 90. Now 1 plus r whole power 10 is 170 by 90. Now how am I getting 1 plus r? So what is yield? Yield is present value, or it is the rate at which present value of all inflows equals either the issue price or equals the current market price. Now here current market price is 90. So you are discounting all these inflows of coupons which are not available for reinvestment and the maturity value at some r percentage. So which is why you are doing it at the 1 plus r whole power 10. So you find out 170 by 90 10th root. Now how do you find out 10th root? I will explain separately in a video. I have already explained in a video how to compute the 10th root using calculator. If you compute that, you will get a value of 6.5% for half yearly. So the yield is not actually even 7.77 is what we saw, no? 7.77 is what we were getting here. 7.77 half yearly and 15.55 on an annual basis. That is also not the case. It is 6.5% half yearly. Now see, here I have written also. How do you compute the 10th root on a calculator? Write the number on your calculator. What do we have to compute here? 170 by 90. 10th root of that, 170 by 90. It comes to how much? 1.88888. Okay. Then press square root button 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Subtract 1 minus 1. You get a value. divide this by n, where n is a nth root. So, you have to divide this by 10, okay. Then you again add 1, okay. Then you press into is equal to 12 times. Into is equal to once, twice, thrice, 4, 5, 6, 7, 8, 9, 10, 11, 12. So, you get a value 1.06556. So, the root 1.888 10th root is 1.06566. So, answer is 6.566%. That is how you get it. Okay, this I will, there's a calculator tricks video also, you go through that, but I thought probably why don't we just do it along with this problem. Okay, now let us look at the next problem. So, friends, let us look at the next question. MP Limited issued a new series of bonds on 1st Jan 2010. The bonds were sold at par, having a coupon of 10% and mature on 31st December 2025. So, if they are sold at par, meaning yield and coupon both are same. Coupon payments are made semi-annually on June 30th and December 31st each year. Assume that you purchase an outstanding MP Limited bond on 1st of March when the going interest rate was 12%. Required. What is the YTM of MP Limited bonds as on Jan 1st, 2010? So, as on Jan 1st, 2010, the day on when it was issued, the bond sold at par. So, YTM is also 10. Very simple part. Second question is more important. What amount you should pay to complete the transaction? What transaction is this? Assume you have purchased an outstanding bond on 1st March 2018. So, 2018 March you are buying a bond and the going interest rate was 12%. So, you are going to buy it at 12% yield. So, but please note this is an in-between period transaction, in-between coupon periods transaction. So, you have to account for the interest due also, interest accrued also. What is the date of purchase? 1st March. 2 months are over, 4 months are there for interest because interest payment dates are 30th June and 31st December. Now, semi-annual coupon dates are so and so. On 1/3 price includes 2 months accrued interest, correct? Which is what I said. So, P0 is present value. If you remember, I told you the formula how this has to be computed. First, present value of the coupons, which basically is half yearly coupon, 10% on 1000 is 100, half of that is 50. So, 50 in present value annuity factor for 15 years. Why am I taking 15 years? See, we are in 2018. How many installments have been paid? It started on 10. So, 10 to 11, 12, 13, 14, 15, 16, 17. So, 8 years installments have been paid. So, 8 twos are 16 installments have been paid. How old is the bond? Bond is still 25. So, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. Then 20, 21, 22, 23, 24, 25. So, it is a what bond? It is a 16-year bond. 16 into 2 is 32. Out of 32, how many installments have been paid? 16 have been paid, right? 16 have been paid. But how are we going to price out of 32, 16 paid, 16 balance, right? Now, 16 paid and 16 are balance. Then, how do you find the price of the bond? You find the price of the bond on the next payment date, next coupon payment date after the coupon is paid, and to that add the value of the coupon. So, you compute it after the next coupon payment is made. So, you will compute it with 15 periods. For 15 periods, because 16 are balanced, you compute it for 15 only and then add directly the coupon value. So, you take it at 6% because current yield is 12, annualized yield is 12, half yearly yield is 6. So, you compute the present value at 6% for 15 periods and 1000 say you multiply, which is the redemption value for 15th period, whatever is the 6% discounted, whatever is the present value factor, you compute and multiply. So, you get a value which is 50 into 9.712 and 1000 into 0.417, which is 902, but this 902 is after payment of the coupon. So, to that you add the value of the coupon, which is 50, so you make it 952. So, but this is the value at on 30th of June 2018 after the coupon is just before the coupon is paid. Just before the coupon is paid, this is the value. That value you have to bring forward to current date. Now, this is the price on 952. What is the price on 13? So, you have to bring it forward. How will you bring it forward? You take the current yield. So, you have to move it forward from June to March. You have to bring it forward by 4 months. So, what you do is 952 into 1 by 1.06 power 4 by 6. Why 4 by 6? Because 2 months have elapsed, 4 months are left. So, you have to bring it back by 4 months. So, 952.88 by 1.06 power 2 by 3. Now, when you have to compute power 2 by 3, I just now showed you in the previous problem, how do you compute a power 10 or power, How do you compute a exponent value? And same thing can be applied here also. So you find out a value which comes to 1.0396. So that is the present value factor. So you divide 952 by 1.0396, you get 6.1657, which is the dirty price. This is the dirty price. It actually includes the interest also. Now the question that they have asked is how much would be accrued interest and how much would you represent the basic value of the bonds. So you have to compute the interest that is accrued for 2 months. It is very simple. The interest is 50 rupees for 2 months, right? So 50 into 2 by 6, which is 1 by 3, which is 16.67. So this 916.57 includes 16.67. So clean price or the basic value of the bond is 916 minus 16, which is 899.9. I think it is very similar to the problem that we solved when I was trying to explain. It's a very simple concept, just that you have to be careful of what you are doing. Let us move to the next problem. This is a good type of question. These kind of questions have come up multiple times. ABC Limited has 300 million, that is 30 crores. 12% bonds outstanding with 6 years remaining to maturity. 12% bonds with 6 years maturity balance. Since interest rates are falling, ABC is contemplating refunding these bonds with a 30 crore issue of 6 years bonds carrying a coupon rate of 10%. So you are refinancing. Issue cost of the new bond will be 6 million, that is 60 lakhs, and the call premium is 4%. That is, when you are calling back the bonds, you have to pay a premium of 4% of the value of the bond. And 9 billion being the unamortized portion of the issue cost of the old bonds, which can be written off no sooner the old bonds are called off. So when you have an unamortized premium, that can be written off. They are giving an assumption. So you can write off that unamortized premium. Marginal tax rate of ABC is 30%. You are required to analyze the bond refinancing decision. So what is happening here? This is one very, lot of working oriented problem. You are having an old issue, new issue. In old issue, there are some benefits, new issue, there are some benefits. You have to do a cost benefit analysis after considering the lower interest cost. And if the value of all the benefits exceeds the cost, then you can say, yes, of course, go ahead with refinancing. So how do we do? 300 million or 30 crores is the old bonds. 12% premium is what? 4%. 4% of 300 million is 12 million. So 312 is the total outflow. New issue, you are going to get 300, but you are also having to meet 6 million as new bonds cost of issue. So your net proceeds is 294. Now, call premium and unamortized cost. So what we assume in all these problems is the premium on call, whatever this 12 million that you have paid right here, this number, that premium that you have paid is a tax deductible expense. Same way, the expenses of write-off of issue expenses, the issue expenses write-off are also tax deductible, but they are amortized over the period of the bond. So call premium is how much tax savings on call premium and unamortized cost. So call premium is how much? You have 12 and unamortized calls, and we are referring to the old bonds here. So 12 is the call premium, which is what we discussed here, and unamortized 9 million being unamortized cost of the old issue. So on this 12 plus 9 is 21, 21 into 0.3, 21 into 0.3, 6.3 million is the tax saving here. This is one number. So initial outlay is 312 minus 294 minus 6.3. Why minus 6.3? Because that's a tax saving that you are getting. So you are getting 11.7 million. Now this is the outflow. Now you compare the inflows, right? This is the outflow, and now you compare the present value of all the inflows. What are the present value of inflows? What is the annual saving in interest? You are going to save 12% minus 10% on 300 million. That is 2% on 300 million, which is 6 million. So you are going to save 6 million. Then this 6 million is the gross interest. This is the gross saving. But there is also a tax deduction. So you have to compare the tax deduction and then compute. But the tax deduction is not only for this, but there is also a tax deduction for your issue expenses. Old issue expenses were 9, new issue expenses is 6, and old issue expenses are 9. So there is a reduction in amortization. So you take 9 minus 6, which is basically a reduction in amortization or depreciation that you can do. Depreciation is for fixed assets. Amortization is for intangible assets. So 9 minus 6 is basically 3 is reduction in amortization value, that is over 6 year period. So you do 3 by 6, and there is also a reduction in interest, which is 6 million per annum. So that is also a reduction. So 6 plus 3 by 6, which is 6 plus 0.5, which is 6.5. On 6.5, every year you are actually losing 30% of tax benefit. So that also you compute 6.5 into 30%. 6.5 into 0.3, you get 1.95. So the net saving is 6 minus 1.95 is 4.05, but this is annual saving. Now you have to do this for how many years? Balance 6 years. So at what rate? At the new rate. What is the new rate? They have specifically said new rate is the new coupon rate is 10%, but 10% is the gross pre-tax. Now post-tax it comes down to 7%. So 4.05, you compute the present value factor for 6 years at 7% on an annual basis. You get a present value factor as 4.799766 and multiply 4.766 with the annual saving of 4.05. You get total saving as total inflow or total savings or inflow as 19 million. Whereas the outflow is 11 million. So the net savings is 7.66. The bond should be refunded. This kind of questions, there are multiple questions. Please go through, solve one of them on your own, because these kind of questions, if they come in the, if they come in the exam, you can hit them straight for a 6. Very, very simple. You should not get confused, that's all. So if you see, I keep on saying, don't get confused, don't get confused, don't get confused. The reason is very simple. Most of the students are confused with this. They don't know what is happening. Okay. So if you solve problems, the confusion will reduce. Anyway, let us move to the next one. This is a debentures convertible question. Let us ignore that. It is also fully convertible. So friends, now let us look at the next one. HLL has 8 crores of 10% mortgage bonds outstanding under an indenture. The indenture allows additional bonds to be issued as long as the following conditions are met. Pre-tax interest coverage ratio, that is PBT plus bond interest divided by bond interest, remains greater than 4. Net depreciated value of mortgage assets remains twice the amount of mortgage debt. Debt to equity ratio remains below 0.5. HLL has net income after taxes of 2 crores and a 40% tax rate. 40 crores in equity, 30 crores in depreciated assets covered by the mortgage. Assuming that 50% of the proceeds of the new issue would be added to the base of the mortgaged assets and if the company has no sinking fund payments until next year, how much more 10% debt could be sold under each of the 3 conditions and which protective covenant is binding? Now, this is a very interesting and twisted question actually. They have not explained what this indenture is, what is a covenant is and all that. Covenant means some ratios which you have to follow as a bondholder so that your bonds can remain outstanding. If you fail to meet those ratios, there are penalties and consequences. Either interest rate will increase, or if things go bad, the bonds can be put by the bondholders, so on and so forth. Here, what is the question? First one. How much more 10% debt could be sold under each of the scenario? It is individually each of the scenario. Okay. So, pre-tax interest coverage should be income before tax plus bond interest by bond interest. That basically is EBIT by bond interest. So, that is supposed to remain what? That is supposed to remain greater than 4. What is current pre-tax interest and bond interest? Net income after taxes of 2 and 40% tax rate. So, 2 is after tax. So, 2 by 0.6. 2 by 0.6 is how much? 2 by 0.6 will get you 3.33. So, 3.33 crores is the PBT. To that you also add the interest. What is the interest? As 8 crores of 10% mortgage bonds. 8 crores into 10% is 80 lakhs. So, 3.33 crores plus 80 lakhs, which is 4.13 crores. Okay, 4.13 crores. That is the existing covenant, 4.13. Plus, you are planning to issue additional bonds. What are the additional bonds you are planning to issue? How much more 10% debt could be issued? So, whatever is the existing EBIT, to that you also have this additional interest that burden will be there, right? So, additional interest, let us assume that the X is the total bonds issued or loan raised, of that 0.1x, right? 0.1x will be the additional interest that will be there. Assume that there is no increase in income and all of that, and the denominator is existing bond interest. What is existing bond interest? 0.8 crores. 0.8 crores plus 0.1x. So, numerator is 4.13 plus 0.1x. Denominator is 0.8 crores plus 0.1x and equate both of them to 4 because 4 is the ratio that you have to maintain and solve for x. So, you will get value of x as 3.1 crores. So, what this basically says is even if there is no increase in income, you can raise up to 3.1 crores of loans at 10% interest rate such that covenant number 1 is still met. Next covenant. What is next covenant? Net depreciated value of mortgage assets remains twice of the mortgage debt. Net depreciated value of the mortgage assets. What is the net depreciated value of current mortgaged assets? 40 crores in equity, 30 crores in depreciated assets. 30 crores is the depreciated assets. So, net depreciated remains twice the amount of debt. So, 30 is the numerator and existing denominator is what? Existing denominator is 8. So, you can add 50% of a new loan and that entire new loan gets added such that this ratio is maximum of 2. Right. So, 30 crores plus 0.5x by 8 crores plus x is equal to 2 and you solve for x, you get a value of x as 9.33. You can take additional loan of 9.33 crores without breaking this covenant. So, what is the third covenant? Third covenant is debt to equity ratio to remain below 5. What is current debt to equity? 8 is the loan, 40 is the equity, it is 0.25, less than 0.5. So, how much debt can you take such that this ratio is equal to 5? Does it exactly equals 5. So, this basically you solve for this, what you get is equal to 0.5, again I made a mistake, 0.5. So, you solve for this, you get value of x as 12 crores. Now, in all three conditions, you can raise additional debt, but each one different value. Since all conditions are to be met, at least 3.1 crore can be borrowed by issuing additional bonds. Why is 3.1 crore? The first condition is 3.1 crores and that is the binding condition. That is, that limits the amount of debt you can take. See, what is the in the first case, in the third case, you can take 12 crores. In the second case, you can take up to 9.33. In the first case, you can take up to 3.1. So, 3.1 is the maximum you can take if you have to meet all three conditions and that is the binding condition. Let us move to the next question. This is an interesting one. Consider the following data for government securities. Coupon rates, different coupon rates are given, different years are given, current price are given, YTMs are given. Now, calculate the forward rates for years 1 to 5. Fantastic question. So, for the first year, forward rate and spot rate are same. Spot rate is basically from, spot rate is a rate that is for a full, that is for a loan of a specific tenure and the same rate is applicable for all the years. So, here yield to maturity is 12.56 for a 1 year loan. So, the same rate is the forward rate as well as spot rate. Now, 2 year maturity, this is a coupon, there is a coupon, 2 year bond is 12.75. So, and assume they are annual coupons. So, first year 1275, second year 1275 plus 10,000 rupees which is coming back and present value you have computed 13.128%. You computed 13.128 because that is a 2 year discount rate. So, you get the value of the bond as by taking 13.128%, you get the value of the bond as 9937, right? You computed 9937, but this 9937 has to be arrived at by using two different rates. One rate is 12.546 and some other rate which you have to find out. So, 1275 which is a coupon divided by 1 plus 1.12546 which is the first year rate plus 11275 divided by 1 plus 1.12 by 1.12576 into forward rate for second year, that is rate applicable from end of first year to the second year. So, you solve for this, you get a value of F2 which is 13.789. So, 13.789 is the F2. Like that you go on and solve for each year. Every year you take the previous 2 years rates and because they have already given the prices here, no, 9937, 10,035, 997 and so on, you equate that prices to sum of present values of cash flows by taking a forward rate applicable for each cash flow. So, for the first year you take 12.54, for second year you take 13.78 and 12.546, like that you do and you solve for it and you get the value. You get 13.89, 14.59 and you get 15.622. Okay, let us move to the next one. Following is information for option free bond. It's not free option, option free bond. Face value is 1000, coupon rate is 7%, terms of maturity is 7 years, yield to maturity is 8 years. You are required to calculate the price and duration of the bond. If there is an increase in yield by 35 bps, what would be the price of the bond? Very, very simple. You have done this. I'll do it very, very fast. Okay. Market price and duration. What is market price? This every year coupon is 70 bucks. 70 rupees. So, 70 into present value factor at 8% for 7 years plus 1000 into present value factor 8% for the 7th year. You compute summation of this, you get price as 948. Then you compute duration, present value into cash flow into time. So, you get 5.73. So, the duration of the bond is 5.73. This is Macaulay duration. This is not modified duration. So, if you have to compute for a 35 basis points, you can do it by You can do it either by taking the cash flows again at 8.35% instead of 8%, which is current YTM is 8, take 8.35, that is one way, in which case you will get a 930.15. But if you want to do it using modified duration, which is Macaulay duration by 1 plus YTM, which is 5.73 divided by 1.08, so you get 5.306. 5.306 is the percentage change in the price of the bond for a 1% change in yield. So for a 35 basis points yield change, it will be 0.35 into 5.306 into 948. Why 948? 948 is the current price. So you will get the change as 17 rupees. Now if there is an increase in yield, what is this? Yield, increase in yield, price will come down. Those 17 rupees will be a decrease in price. So 948 minus 17, you will get 930.94. Whereas when you computed it with actual cash flows at 8.35% as a discount rate, you get 930.15. So there is a slight difference between these two. It is a small adjustment. This adjustment is on account of convexity. Okay, but the best way to price a bond is always discount the cash flows afresh. But if you don't have that, then use modified duration, which is basically Macaulay duration by 1 plus Y. Okay, next, let us move to the next one. A bond has annual modified duration of 7.2 and annual convexity of so and so. The bond's yield to maturity decreases by 25 basis points. The expected percentage change is close to what? So, they have asked you this exact question, which is, what is the change in price given modified duration and convexity? So, yield is come down by how much? 25 bips, so price will go up. So, actual change in formula, how do you find out the change? Change in price is modified duration minus modified duration into percentage change in yield into price plus for the convexity. Convexity also you have to account for it. Convexity value they have given as 65.18 into half into price into half into price into change in yield whole square. So, percentage change in price will be, you fill up this particular formula. What will be this be? Minus 7.02, which is basically your modified duration, into change in yield, which is a reduction in yield, correct? Decrease in yield, so minus 0.025 plus, and here because there is a reduction in yield, you actually put minuses in before it, plus you get a 0.025 whole square into half into 65.18. So, you basically compute all of this, you get a value of 1.78. This is the percentage change in price. The existing price we don't know. So, the percentage change in price is this much. If there is a decrease in yield, there is going to be an increase in price. So, you have to say that increase in price is 1.78. Let us move to the next one. So friends, let us look at this next question. Based on the following data, estimate the NAV on 1st July as per unit basis of a debt fund. Okay, forget the mutual fund concept. We will learn that. If you already revised it, it is no problem, but there is no major fancy thing around the unit value. It is a very simplified thing. Okay, these are the assets that this particular mutual fund has. Various government securities, face value, purchase price, maturity date, number of securities, coupon dates, duration of the bonds. The number of units is 1 lakh units of 10 rupees each. All securities were purchased when an applicable YTM was 10%. On NAV date, the yield increased by 75. If yield increases, price comes down. And cash in hand and accrued expenses were 6,72,000 and 2,37,000. This we will see later. Okay. Now, what is it that you are supposed to compute? Base the revised NAV. How will you compute revised NAV? NAV is just a total value of all these bonds as on a specific date divided by the number of units in the portfolio. They basically have 1 lakh units, so we divide by 1 lakh, that's all. Now, you have to compute, there is a purchase price, you have to compute what is the change in the price. So, how will you compute change in the price? Either you have to reprice or you already have the duration, and there is only one change in price, one change in interest rate. So, you can use duration to compute the change in price. What is the increase? They were all purchased when YTM was 10%. Now, increase in rate is 75 basis points. So, what you do is, you have this purchase price, number of securities. Each place they have given the number of each bond, they have given number of securities. You know the total value. For each bond, you know what is the duration. And modified duration is, what is modified duration? This duration what they have given is Macaulay duration. So, modified duration is this by yield. And yield, if it is an annual bond, if it is an annual bond, you divide by 1.1, or if it is a semi-annual bond, you divide by 1.05. Okay. So, first one is 7.3494, you divide it by 1.1. Next one is semi-annual, you divide by 1.05. Like that, you compute for each of them the modified duration. You compute modified duration under new yield or under the new YTM or old YTM, you compute under old YTM, because you compute duration in Macaulay and modified duration when you make a purchase. After that, when the interest rate changes, then you use the duration to compute the value of the change in price because of the change in interest. Once you've got this, change in price is how much? Minus change in yield, which is minus your 75 basis points into modified duration into the price. So you can directly, instead of multiplying with the price, you can multiply directly with the value of the investment itself. So what you do is 1,04,78,000 is value of investment into the modified duration into 0.75%. So in all the cases, yield has gone up, so price will come down. So all of them, it is a minus. So the change in price or the change in the value of investment is computed here, which is minus 525,048. Same way you compute for all the other bonds also, you get minus values. So those are the total reduction in values. So this is the bond, this is the reduction in value of the bond, this is the portfolio, this is the reduction in value of the portfolio, and expected value of the entire portfolio post the reduction is this much. 203,11,506. Now, how do you compute the NAV? NAV is very simple. You take the value of the portfolio, add the cash in hand, subtract the interest expenses, and also consider accrued interest. That's a very important thing. How do you consider accrued interest? We will look at it in the working note, and then you get the value of the assets divided by 1 lakh units. You get per unit NAV is 211. Now, how do you compute accrued interest? Accrued interest is there for which all bonds, and we are doing it this on which date? On 1st July. Now, on 1st July, if you have a bond, you're computing the value on 1st July. If any dividend, if any coupon is already been paid on 30th June, you will not consider. So, the 4th bond is out of question. First 3 bonds, and in the first 3 bonds also, one of them is a semi-annual coupon. So, 30th June, there is a coupon payment. So, that also is not there in question. There is no accrued interest for that as well. So, accrued interest is only there in case of bond 1 and bond 2. For both of them, you have accrued interest for 3 months, April, May and June. So, you take the bond value, face value of the bond, number of the bonds, and 10.75% and 5%, which are the coupons. The first one is an annual coupon, so you don't adjust it for semi-annuality, and into 3/12 because 3 months interest is pending. For the second case, it is 6 months. Every 6 months you pay, that is semi-annual coupon. So you do it into 3/6. So you get accrued interest value. You add the accrued interest to the NAV computation, and you get the total NAV as 211.396. It's a very interesting question. See, but only problem that I have here is face value is 10, but NAV is 211, especially in bonds, especially when you have a bond portfolio, it is not equity, it will not grow so much. So this is one doubt that I have. Probably the units count may be incorrect. In units count may not be 1 lakh, it may be 2 lakhs or 20 lakhs or something. But based on the data that is given, we have solved this particular problem. So we have covered all varieties of problems, all kinds of twists and turns as far as bond, duration, immunization, rate, bootstrapping of interest rate, that is spot rate and forward rate, then, the link to convexity, then, everything, current yield, everything, all varieties we have covered. And replacement, refinancing decisions, gain or loss, all varieties we have covered. If you have got all of these, then you are sufficiently prepared for this aspect. Now, let us move to the next aspect, which is all about conversion, options, and then, repo, commercial paper, so on and so forth. So friends, after having understood about features of a bond, how does a bond function, how does the price change, what are the factors influencing it, how do the interest rates impact it, what is immunization, what is convexity, we have understood all of those and also looked at the problems related to them. Now let us look at the next aspect, which is about convertible debentures. This also comes as part of the fixed income chapter. Now, what are convertible debentures? These are those debentures which are converted into equity after a certain period. They are a type of a loan which generally has conversion terms pre-decided at the time of issue. So, these convertible debentures, the conversion parameters or the conversion requirements are pre-decided at the time of issue of debentures. Let us take an example. Let us say the maturity value of the bond is 1000 rupees and each bond is converted into an equity share at the rate of 1000 rupees per equity share. But each equity share you are converting at the option of the bondholder into equity share, where the equity value is pre-decided at 1000 rupees. And this is decided that this conversion option will kick in after 5 years. Bond maturity is 6 years, this conversion option will kick in after 5 years. Now, when will a bondholder want to convert this into equity shares? Let us say the value of each equity share is 10,000 rupees. Then you are getting an equity share only at 1000 rupees, so you will be willing to convert. Let's say the value of each equity share at the end of 5 years is only 100 rupees. Why will I convert my bond of 1000 rupees into a share of 100 rupees when if I wait for one more year, the bond, I will get the maturity value of full 1000 rupees. So, there are various aspects that have to be considered like this. And then bondholders take a decision to either convert to equity or not convert and redeem the bond as it is. Right, you can call it bond debenture, doesn't matter. Now, what are convertible debentures? Convertible debentures have three aspects that you should be aware of. First one is something called as conversion ratio, one is something called as conversion price, third one is conversion value. I discussed all three of them in the example that I gave. What is conversion ratio? Number of shares for each convertible debenture. So, if you hold one debenture, how many shares will you get? That is known as conversion ratio. Conversion price. I said that bond maturity value is 1000, and when you convert into equity share, you are allotted an equity share at a price of 1000. That 1000 includes a face value plus premium, both put together is 1000. So, whatever 1000 rupees you have outstanding as a bond value is converted into one equity share in the same 1000 rupees. So, that is a price paid for equity shares. Conversion value. What is conversion value? How many shares do you get and what is the price of each share that is being allotted to you. In our case, it is 1 into 1000, it is 1000. It can also be 2 into 500. You are allotted 2 shares for every bond. Each share is valued at 500 rupees. So, ratio is 2 for everyone, conversion price is 500 and conversion value is 500 into 2, which is 1000. Okay, so that is how this thing works. Next, we also have something called as warrants. I want to cover these two together. What are warrants? Warrant is a right that entitles a holder to subscribe equity shares during specific period at a stated price. So, what usually happens is when you issue debentures or bonds, in addition to allowing the debentures or bonds to be directly converted to equity, in which case the loan value becomes 0 and equity value gets substituted for the equivalent of loan value, you can also do another thing, which is I will allot you bonds. Each bond gives you a warrant. The warrant allows you to subscribe to equity shares. So, what is that logic? Warrant. What is a warrant? You get a bond, or you get a preference share, or you are allotted an equity share. You are allotted an instrument. Along with this, there is something called as a warrant. And this warrant is like an option. At your choice, if you want, you can convert this into equity share. Convert to equity at choice of holder. So, in this, the original instrument, this particular original instrument will remain. There is our original security. There is a new security called warrant, or the security that is allotted along with the original security called warrant, that will convert into, or that will entitle one to subscribe to equity. Actually, I should not even use the word convert. I should use the word subscribe. This warrant will give the right to the holder of the warrant to subscribe to a fresh equity issue at a predetermined price. Subscribe at pre-agreed price. Okay, so that is what is a warrant. Now, what are the characteristics of, or why are warrants issued? They are generally issued to sweeten a debenture issue. So, if some debenture holder, or you are proposing a debenture issue and you want to entice people to subscribe to the issue, or you want to sweeten the deal, you typically issue warrants along with that. Warrants versus convertible debentures, basic differences. Warrants, option of conversion. Warrant is detachable and can be separately traded, yes. Whereas convertible debenture, you cannot separate the conversion option. Cash payment, excisable for cash payment. So, warrants, because you have a right to subscribe to fresh issue of equity shares, the fresh issue will demand that you as a warrant holder pay some money to the company. Whereas in case of conversion, no need to pay. Existing debenture is converted from debt to equity. Now, what is value of a warrant? Value of a warrant is something like this. MP, what is MP? Current market price of the share, whatever is the latest traded market price, minus exercise price of the warrant. So, what people typically do is, when you issue a warrant is issued for you to subscribe the share at a price that is lower or that is predetermined, and that is probably more often than not lower than existing price. So, you have a, let's say the current market price is 100. You have a right to subscribe to share at, let's say, 50. You are making straight away 50 rupees profit, no? Why are you making this profit? Because you had, entered into a deal where you basically lent money to the company in the form of a debenture. That debenture came with an option or a warrant like this. And what is N? The value of a warrant is number of equity shares convertible with one warrant. Let's say each warrant gives you one equity share. Then the value that you get, which is value of a warrant, is 50 into 1. And what is this 50? This second 50, 100 minus original 50, which is the number, the price at which you can subscribe the share. Or let me change that slightly. Let's say the rate at which you can, or price at which you can subscribe the share is 40. Then 60 is what you gain. So, value of the warrant is 60 into 1, which is 60 rupees. So, that is what is the value of warrant. Now, after having understood broadly about what are convertible debentures and what are warrants, let us go and have a look at some of the problems related to this. So, friends, now let us look at the first problem in this. There are some more new terms that you will learn as we progress with these problems. The first problem is a convertible bond with a face value of 1000 rupees is issued at 1350 with a coupon rate of 10.5%. The conversion rate is 4 shares per bond. The current market price of the bond and share is 1475 and 80 respectively. What is the premium over conversion value? Now, let us look at this. Given face value is 1000, that is very clear. Issue price is 1350, coupon rate is 10.5. Conversion rate is 14 shares per bond and market price per share is 80. So, you get 14 shares, each one is worth 80 rupees. So, if you will get conversion value as 14 into 80, which is 1120. Now, what is the market price of the bond? The current market price of the bond is 1475. What is premium over conversion value? So, this particular bond is trading at 1475, whereas the value of the equity shares that it represents, which you will get once the bond is converted, is only 1120. So, it is trading at a premium to its conversion value. So, that premium is 1475 minus 1100, which is 355 rupees. So, 355 rupees, when you compute premium over conversion value, you typically look at the conversion value is 1120 only. You look at the premium as what is the premium over the conversion value. So, 355 by 1120 into 100, you will get 31.7%. Now, this is a very simple problem. Let us go and look at a slightly advanced problem on this, where you will learn new terms. Again, when I say advanced, there is nothing really fancy in this. It is a very, very simple one. Let us see. This is, I think, question number 23. Given data below relates to a convertible bond. Very good. Face value of the bond, when they say face value, they are referring to the bond, not to the equity share, is 250. Coupon rate is 12%. Number of shares per bond is 20. Market price per share is 12. Straight value of the bond is 235. Market price of the convertible bond is 265. What is the straight value? What is this new term that we have learned? I will explain to you. As we see the solution, you yourself will understand. You are required to calculate stock value of the bond, percentage of downside risk, conversion premium, conversion parity price of the stock. Again, all these are new terms. Let us go one by one. Stock value. What is stock value? Stock value is nothing but conversion value, which is conversion ratio into conversion price. What is conversion price? Conversion price is 12 and conversion ratio is 20. So, 20 into 12 is 240. The stock value or conversion value is 240. So, first one is over. Percentage of downside risk. What is the downside that is possibly there? Downside from where? Downside from existing market price. What is existing market price? 265. From 265, it can come down. Now, if it comes down, to what will it come down? See, you have three ratios here. Bond, face value 250, market price 265, conversion value 240, and then they have given something called as straight value as 235. Now, this is bond face value, we understood, it is very clear. Bond market price is stayed in the market, very clear. Bond conversion value 240 is also clear. Now, what is the straight value of 235? What this means is, bond's face value is 250 for a coupon rate of 12%. So, if market rates are higher or lower, this particular bond, assuming that the issue price is same as the face value, the bond's price will fluctuate. Now, bond's price today is 265. Now, this 265, does it represent only the value of the bond for its cash flows, or does it represent the value of the bond for its the option that is attached where you can actually convert into equity share? It represents both. So, this 265 represents equity plus bond. Now, it may be either equity or bond, but then you have a choice of equity or bond. You have a choice. See, you cannot have both equity and bond from the same instrument because it is not a warrant, it is a convertible bond. So, a convertible bond or a convertible debenture, either you choose to convert or you choose not to convert. Now, when you choose to convert, you will get the value of equity. When you choose not to convert, you will get the value of the bond. However, you have a choice, you have an option, there is an optionality. Excluding the optionality, considering only the cash flows from the bond as interest and maturity value, whatever is the payment, the price of the bond is 235. So, 235 represents the straight value. Straight means something that is clean excluding the conversion. When I say clean, don't go back to dirty price, clean price. I am referring to clean here in terms of excluding the conversion option. So, without the conversion option, it is 235. With the conversion option in the market, it is 265. Now, you may ask me, sir, how do you know it is? Where will I get this 235? So, in market, when you look at the price of 265 and when you look at the same similar kind of bond without the conversion option, same, 250 rupees fair value, 12% coupon rate and same maturity, it may probably be trading at 235. Or if it is not trading, you look at a bond which has a similar yield and compute the price given the yield. Then you get a value called straight value, which is 235. Now, this 235 versus market price of 265, there is a gap of this 30. This 30 is the value of the option. It is the premium, that option. Because of having this optionality, the market is giving it an additional premium or price of 30 rupees. Now, the question is, what is the percentage of downside risk? So, from wherever it is 265, where can it fall down? It can fall down to the straight value, because if the optionality is worthless, that is, you are not going to exercise the conversion option and convert it from debt to equity, then you are going to treat it as a simple bond. If it is a simple bond, it will trade like other bonds, and other bonds traded of same maturity, same coupon, same yield, same rating, traded 235. So, the lowest value that you can get from your bond is 235. Now, there is also one more argument. If the company goes bust, the lowest value that you will get is 0. But we are looking at here on a going concern basis. We are not looking at a scenario where we are thinking that the company is going to go bust. If that is the case, then the value of the bond is 0. But here the downside risk is purely on a going concern basis. The price can fall down from 265 to 235. So, the 265 to 235, the percentage of downside is 12.77. Or I actually think you should compute it like this as 11.32, simply because downside is from one level. So, you compute the percentage also from that level, and that level is 265. So, from 265, downside is 11.32%. I would stick with this computation, second computation. However, if you want to do both and leave it, because institute sometimes has given even the first way as the answer. But I genuinely believe second way, because when you are computing from somewhere, a downside from somewhere, the denominator should be that from value. It cannot be the to value. Okay. Next, what is this conversion premium? Conversion premium is what we already discussed. Whatever is the value that you will get on conversion, the equity value, conversion value, that is one number, and whatever is the current market price of the particular bond. So, current market price of the bond is 265. When you convert into equity, you get 240. So, the particular premium that you are getting over the conversion value. So, conversion premium is premium over the conversion value. So, 265 minus 240 by 240, you will get 10.42%. So, this is the second concept that you have to learn. What is the conversion premium? First one is, what is the percentage of downside risk which is computed from the straight value. Next, what is conversion parity price of the stock? So, conversion parity price of the stock means you are going to get how many shares? 20 shares. And currently, the market price is 265. This 20 share, each share is trading at 12 rupees. So, this is why you are getting 240 versus 265. Now, how much should this share price change? From 12 to where, such that you multiply that where called X and you get a value of 265. You multiply this 20 into x and get 265. So what? Divide 265 by 20. You will get a value of 13.25. So if the equity price is 13.25, or if you are converting each bond at a price of 13.25, that will reflect existing bonds, whatever you get, 20 bonds per debenture, into the conversion rate. You will get a value which is equivalent to your current market price of the bond, which is 260. This indicates that the price of the share rises at 13.25 from current 12. Investor will neither gain nor lose on buying the bond and exercising it. Observe that 1.25, that is 13.25 minus 12, is 10.42% of 12. So if you look here, what is the conversion premium? Conversion premium is 10.42. So this 1.25 is 1.25 by 12. If you do, that is exactly the conversion premium. That is what we are talking about. Okay, interesting question, right? So these are the kind of questions that may be asked in the exam. Now let us look at the other ones. Let's look at the next question. Sriram Limited has issued convertible debentures with coupon rate of 11%. Each debenture is an option to convert to 16 equity shares at any time until maturity. Debentures will be redeemed at 100 on maturity of 5 years. Investor generally requires a rate of return of 8% on a 5-year security. As an advisor, when will you advise investor to exercise the conversion for given market prices of 5 rupees, 6 rupees, 7.1 rupees? Cumulative present value factor for 8% for 5 years is 3.993, and present value factor for 8% for year 5 is 0.681. Now the question is, when will you ask your investor, as an advisor, when will you ask an investor to convert given the specific market price? Now the point here is, you have to figure out how many equity shares you are going to get. Each equity share, what is the price at which it will make sense for you, and what will you compare it with? How will you figure out whether it is making sense or not? You will compare the value of the bond if you were to hold the bond versus value of the bond if you were to convert it into equity. So if you hold, what will you get? You see, they have specifically said an investor generally requires 8% return on a 5-year security. So if you are holding it for 5 years, you get interest of how much? 11% coupon. 11% on what? 11% on 100, which is 11 rupees. So 11 rupees for 5 years, cumulative present value factor is 3.993. Why is cumulative present value factor 3.993? Because current discount rate for bonds is 8%. So 8% present value annuity factor is 3.993. Then in the 5th year, you will redeem entire 100. 5th year, same 8% present value factor is 0.681. So you add these two, you get 112. So 112 is the value of the bond today. The bond's face value is 100, but today the market price of the bond is 112. And given that interest rates are 8%, you will estimate that the value that you will get if this 8% continues is 112. Now, what is the value of equity share? When you convert it at a price of 5 rupees, 6 rupees, 7.1 rupees, you get same 16 shares. There is no change. So the value that you will get is 80, 90 or 113.6. So you multiply 5 into 16, 6 into 16, 7.1 into 16. You will get these three values, 80, 90, 113.60. Now, if you hold the bond is 112 rupees worth. If you convert, in the first case, bond is worth, the equity shares are worth only 80 or 90 in second case. So only if equity shares are worth more than this 112, which is in case 3 where the equity share price goes up to 710, will it make sense for you to convert instead of holding it as a bond? So that is what we have written. Unless the market price is 7.1, conversion should not be exercised. It is a very, very simple solution to what they have actually asked. It's a very simple one, right? Now let us look at one more problem. GH, a AAA rated company, has issued fully convertible bonds on the following terms 8 years ago. It issued 8 years ago. Face value of the bond 1000, coupon 8.5, time to maturity, balance maturity is 3 years. Then interest payment annual, end of the year, principal repayment at end of maturity, and price and conversion ratio, that is number of shares that you will get per bond, is 25. Then current market price is 45. So you will get market conversion price and conversion ratio is given. So conversion value is just a product of these two, 25 into 45, which is what? 1125. Then current market price of the bond is 1170. Now what are you asked? They can issue plain vanilla bonds without the conversion option at 9.5. So they themselves have said 1125 is conversion value, 1175 is market price. Then they are asking straight bond, that is a bond without the conversion option. What is the price? if the interest rate is 9.5, I am assuming, I have not read the rest of the question, but I am generally assuming. Okay, now see, you are required to calculate straight value. You are supposed to calculate straight value at what? At 9.5% for given set of cash flows. Cash flows are what? On 1000, 8.5% per annum, which is 85 rupees for 3 years, and 1000 rupees in the last year, right? So then conversion value of the bond. What is conversion value? Conversion value you already computed 1125, which is basically your 45 into 25 is 1125. Then conversion premium. What is conversion premium? The price at which it is currently trading versus the value of equity shares that it represents as on today. So 1175 minus 1125. It is very simple. 1175 is current market price of the bond. 1125 is the conversion value. So 1175 minus 1125 is 50 divided by 1125. What is 1125? 1125 is the conversion value. So premium, when you say premium over something, not premium is not a subtraction. Discount is a subtraction. Premium is addition. So premium over 125 is the conversion value. You get it as 4.47%. Now what is the straight value of the bond? Straight value of the bond is very simple. This 9.5%, 85 3 years, and 1000 third year at 8.5%. So you get basically 85 into 9.132. plus 85 into 0.834 plus 1085 into 0.7617, you will get 974. So 974 is the value of the bond, straight value of the bond. Now what have they asked? What else? Conversion premium, then percentage of downside. Downside means from where it can fall to where. So it can fall from 1175 to 974. 1175 minus 974 divided by 1175. It is falling from somewhere. So that you will get a value of 17.02% is the downside risk for the bond. Then conversion parity price is again very simple. At what price per share will the conversion value be equal to the, at what price of the share will the conversion value be equal to current market price. So current market price divided by the number of shares. What is the number of shares here? They said 25 shares. So your current market price 1175 by 25, you get 47 or something. Yes, you get 47 is the price per share at which it should, if we convert, it is great. But right now the current market price is only 45. So people will not convert because it is not making any sense to them. Why? They are getting a lower value. How much is the value that they are getting? They are getting only 1125, whereas the bond itself is giving you 1175. Okay. So they would rather sell it off in the market. However, if the exercise doesn't happen and equity shares are not taken, the value of the bond falls to 974. So you should keep that also in mind. Let us look at the next question. Again, very similar question. Face value is 2500, number of shares per bond is 20, coupon rate is 12%, market price is 120, market price of a convertible bond is 2650. What is conversion value? Conversion ratio into conversion price. What is conversion ratio? Number of shares per bond is 20 and market price per share is 120. So 20 into 120 is 2400. Very simple. So the second part is percentage of downside risk. Now what is this percentage of downside risk? For having percentage of downside risk, we need to know the straight value of the bond. Straight value is 2350. So from current market price of 2650, it can fall down to 2350. Okay. So 2650 minus 2350 by 2650 is 11.32%. Next question, what is the conversion premium? Conversion premium means what is your current market price of the particular bond versus what is the value of the equity that it represents. So 2650 minus 2400 by 2400 is, you will get 10.42%. And what is the conversion price parity? The price of the equity shares at which the bond price, which whatever is the current bond price of 2650 is justified. Justified means if you do 2650 divided by number of shares per bond is 20, you will get 132.5. So if the current market price of equity share is 132.5, then investor will neither gain or lose on buying the bond and exercising it. Observe that 12.5, that is 132 minus 120 is 10.42% of 120. So basically the price at which it makes no difference whether you are keeping the bond or whether you are exercising the conversion option by converting the bond into equity. Now let us look at the next aspect, money market instruments. What are money market instruments? Money market is a market for short-term financial assets that closely substitutes for money. Banks, mutual funds, NBFCs, financial institutions and permitted companies are major participants. Okay, basically these money market instruments are issued at a discount, are of short duration for large amounts. The interest rates are not monitored by RBI or anyone. They are very, very liquid and are safe instruments. Typically, okay. But there have been cases where these safe instruments also have gone for a toss. So, there are three kinds of instruments specifically with respect to the interbank market. One is call money, notice money, and third is term money. Call money is segment of money market where lending or borrowing is overnight on a call, that you call and say, I want my money back. Participants are as allowed by RBI guidelines include banks and primary dealers, largely banks only. Okay. Notice market. Now see, call money is every day you have to renew, whereas notice money is for the tenure of the loan between two banks or two financial institutions is 2 to 14 days. Term money is between 15 days and 1 year. So you have three different types of markets based on the tenure of the loan that you take between two financial institutions. Then you have something called as treasury bills. What are treasury bills? Treasury bills are short-term promissory note issued by the government at a discount. Please note, all these amounts or all these instruments are always issued at discount. Interest received on treasury bills is the discount, which is difference between the price at which they are issued and their redemption value. They have assured yield and negligible risk. Government of India doesn't default. They can be issued for different maturities up to 1 year. At present, RBI issues T-bills of three main maturities, 91, 182 and 364. Yields on treasury bills are calculated as follows. So, now the whole story on these treasury bills and other money market instruments is this, which is how is the yield calculated. Yield is face value minus issue price divided by issue price into 365 days by maturity. Okay, so let's say the face value is 100 rupees. You are issuing it for 15 days, or let's take 91 days because it is a T-bill, right? So, it is 91 days. It is issued for 91 days and it is issued at some discount. Okay. What is the discount is what you have to find out in percentage terms. It is issued at, let's say, 99 rupees. So, what you will do is 100 minus 99, which is the total discount, which is 1 rupee. 1 by 99 is the discount for 91 days. So, you do 365 by 91. So, how much will you get? 365 divided by 91 into 1 by 99, basically in percentage terms, is 4%. So, 4% is the 4.05 something. So, 4% is the yield on this T-bill. Please note, 4% is not the interest rate, 4% is the yield on T-bill. Same way you compute yield on commercial bills as well. Commercial bills are, it's an instrument drawn by a seller of goods and buyer of goods. It's self-liquidating. It is either discounted by bank. It is drawn for short period, 3 to 6 months. Yield to investor is calculated as follows. Face value minus the sale value divided by the sale value into 365 by the actual number of days for which the instrument is valid. Next, you have something called as certificates of deposit. These are negotiable term deposits acceptable by commercial banks and other all India financial institutions from bulk depositors at market link rates. These are issued by banks not less than 7 days and not more than 1 year. They are issued in a demat form and as use-on's promissory note. They are just like other money market instruments. CD is a front-ended negotiable instrument issued at discount. Face value is payable at maturity of the issuing bank and yield is also calculated in the same manner. Then you have commercial paper. Commercial papers, they were introduced in 1990 on recommendation of Wagul Committee. They are unsecured and negotiable promissory notes issued by corporate entities. So, they are not issued by banks, they are issued by companies to raise short-term funds directly from the market instead of borrowing money from the bank. Its period ranges from 7 days to 1 year. CPs are issued at discount to face value. The issue of CP partly replaces working capital limits enjoyed by companies with commercial banks, and there is no net increase in their borrowing by issue of CP. So, you cannot say that there is something called maximum purposable bank finance and all of that. This CP is part of the MPBF. Yield on CPs is calculated in the same manner. So, same way is how yield is computed. Then you have something called repo and reverse repo. Repo means RBI sells and buys back. Reverse repo means RBI buys and then sells back. Okay, repo and reverse repo refer to a transaction money market participant raise funds by selling securities and simultaneously agreeing to buy them back. After a specified time, generally at a price which typically includes interest. Sometimes it's also called ready forward contract as it involves funding by selling securities. Repo versus reverse repo. Repo, rate at which RBI lends to commercial banks. So, basically it is the rate at which you lend. How will you lend? You first sell and then buy back. You sell at 90 rupees, buy back at 100. So, I have lent you 90 rupees for an interest of 10. Right, that is how it works. Whereas reverse repo is rate at which commercial banks lend to RBI. That is, commercial banks give the money to RBI, which basically their deposit. Described from by a perspective of seller of securities, it is to fulfill deficiency of funds higher than reverse repo rate. So, when RBI lends you money, they will lend it to a higher rate. When you lend to RBI, the RBI will give you a lower interest rate, lower than repo rate. Purpose of repo is in case there is a shortage in market, you will give money to everybody in the market so that there is no liquidity crunch. Whereas there is excess liquidity, you will do reverse repo. Then as monetary policy tools strive to contain inflation in the economy. So you keep sucking out liquidity, so you control inflation. Aims to control money supply in the economy. So if there is limited money supply, you push more money by doing reverse repo. Formulas for calculation, then again here also you have two things, clean and dirty price. Clean plus interest accrued is dirty. Then you have something called as start proceeds. Start proceeds is when you are starting, when you are basically getting the money, whatever is the nominal value, let's say 100 rupees or something, into dirty price by 100 into 100 minus initial margin by 100. Now you will understand this particular logic only when you solve a problem. So unnecessarily don't get worried, we'll go to that problem. What is repayment at maturity? Repayment is whatever is the proceeds that you get in the beginning into 1 plus repo rate into number of days divided by 360. Please note here it is 360. Everywhere else it has been 365. 365, whereas with respect to repo, it is 360. This is something you have to remember. When we solve these problems, you will understand better. Let's go there. Let us first look at a simple question, then we'll go to slightly more complex questions. So, Z Limited issued commercial paper worth 10 crores. Please note, commercial paper 365 issued at a discount. As per following details, date of issue is 16th Jan. So, if it is issued on 16th Jan, you get money on 16th Jan. Date of maturity is 17th April. That means money goes out on 17th April. So, you don't pay interest for 17th April. Okay, this is 2019. 2019 is not a leap year. So, in 16th Jan, if you got money on 16th, in Jan there are 31 days. So, for first 15 days you didn't have the money. So, you use the money for 16 days in Jan plus 28 days in Feb plus 31 days in March plus you're returning on 17th of April. So, you've used the money for 16 days plus 16 days in April. So, it was 16 plus 16, 32, 32 plus 28 is 60, 60 plus 31 is 91 days. Number of days is 91, see, that is what I got. Interest rate is 12.04%. What is the net amount received by the company on issue of the CP? Charges of the intermediary may be ignored. So, there are usually intermediary charges which may be ignored. So, interest rate is 12.04. The proceeds are received after subtracting the interest rate. So, when you get a problem like this, you should be very careful. First, what is the interest applicable for 91 days? You should find out. You should not directly multiply 12.4% into 91 by 365 into 10 crores, that is the interest value, no. You first find out the interest for 91 days, which is applicable rate, whatever is the yield for that is 3.002%. So, what you do is 3.002 is what you have to pay. You are going to receive some money on which when you add 3.002%, it becomes 10 crores. So, 10 crores into, so let us for argument's sake ignore this 3.00, let us take it as 3. This 10 crores is equivalent to 103. So, there is some x into 3% plus x is equal to 10. Right. So, 10 is basically the after adding interest. So, 10 is equivalent to 103. So, 10 crores into or 10 crores divided by 103 into 3%. So, what you do is 10 crores divided by 1.03002 into 3.002%. This will give you the actual interest that is paid. That comes to somewhere around 0.29 crores. And you subtract 10 crores minus 0.29 crores, you will get 9.708 crores. Okay. So, the easiest way is you are paying something, or rather the CP that you are getting is after subtracting the interest value, and the interest rate is 12.04. So, 100 what you are paying out is equivalent to 103. Okay, is equivalent to 103. So, the amount that you are basically getting is 100 by 103. Because it includes interest. So, you will get some value called some 97 or 98 as a value. On that you are paying 3%. So, which you add to 97, you are again getting to 100. This is what you are computing. You are now computing the value of this 97%, which basically is after subtracting the interest. And obviously, whatever is that 3% on this 97% is also you are computing. Let us look at this next problem. RBI sold a 91-day T-bill at face value of 100 and yield of 6%. What was the issue price? So, let issue price be X. So, issued at X rupees, face value is 100, but the yield is 6% for 91 days. So, you do the same thing like what we did in previous problem. 6% is basically equal to 100 minus x by x into 365 by 91 into 100, or you can do it the reverse way, which is 100 divided by 91-day T-bill at 6%, 91 by 365 into 6%, which comes to what? 91 divided by 365 into 6% to 100. It comes to 1.495. So, 1.4959 percentage is the interest for this period. So, you repay back 100. 100 is the repayment at interest rate of 1.49% for 91 days. So, what is the original loan? So, what you do is 100 divided by 1.014959 will give you the loan value. So, what I will do is I will put this as denominator and 100 divided by 1.014959. You will get 98.526 or 53, and write 526. This is the value. Now, other way to do it is, this is based on what I explained to you in the previous problem. In this problem, you can do it in another simpler way. 100 minus x, whatever is the issue price, 100 minus x is the interest, or whatever is the interest accrued over a period. That interest on 100 rupees for 365 by into 365 by 91 into 100 will give you 6%. So, you solve for value of x. So, you will get value of x as 98.653, 526, right, 53. So, either way, whether you do it this way or you do it this way, you will get the same answer because the underlying logic is same. Next, let us look at next one. Wonderland Limited has excess cash of 20, which it wants to invest in short-term securities. Expenses relating to investment will be 50,000, no problem. Securities invested will have annual yield of 9%. The company seeks your advice to period of investment so as to earn a pre-tax income of 5%. The minimum period for which the company to break even its investment expenditure over time value of money. What is over time value of money? Anyway, let us see. What is pre-tax income required? Pre-tax income required as security investors will have 9% yield, but they need to earn a pre-tax income of 5%. So, if you are going to invest 20 lakhs and return on the investment needs to be 5%. 20 lakhs on 5%, 5% on 20 lakhs is 1 lakh. So, the return needs to be 1 lakh after subtracting expenses. So, here the question is, this 1 lakh is the return that you want, but you don't want it over a year. How much time should you invest such that when you invest in a 9% security, you get it 1 lakh. How much time or how many days should you invest in a security that yields 9% such that you get a 5% return. So, if you are going to invest it 20 lakhs into 9 by 100, which is 9%, for a certain period, certain number of months, you need to get, and you subtract 50,000 out of that, you need to get 1 lakh. That is basically the equation. Or you can do it the other way also. To this 1 lakh, you can add 50,000, 1 lakh 50,000. So, either ways, you will get the same answer. So, what you will do is, if you solve for this particular thing, that is 20 lakhs into 9% into x by 12 is equal to 1.5 lakhs. You have to solve this. So, 20 lakhs into 9% is how much? 1.8 lakhs. So, 1.8 lakhs into x by 12 is equal to 1.5 lakhs. So, your 30,000 goes 5 times, 30,000 goes 6 times, right? Then 6, 2. So, you need to invest 6 ones are 6 and 6, this goes 2 times. So, x is equal to 2 into 5, which is 10 months. So, if you invest for 10 months, earn 9%, subtract 50,000 out of that, you get 1 lakh, which is basically your 5% return. Now, what is the second part of the question? The minimum period for the company to break even its investment expenditure over time. I don't think this value of money is a relevant point, over time. So, you need to recover only 50,000. How long will it take for you to recover 50,000 if you keep getting a return of 9%? So, 20,000 into 9 by 100 into x by 12 or p by 12 minus 50,000 is equal to 0. You solve for p, you get a value of 3.8. This again is a very simple question. I don't know why they have asked a question like this. Let us take this question. The bank, BK Bank enters into repo for 9 days with any bank in 6% government bonds 22 for an amount of 2 crores. The other relevant details are, first leg is you make a payment of 200,650. Repayment is 200,31759. Then initial margin is 1.2 and days of accrued interest is 240. Now, what is this concept of initial margin? We will see. Assume 360 days in a year. You are required to calculate repo rate, dirty price and green price. What is repo rate? You have given a loan of how much? You have got back how much? So, what is the difference? Additional whatever you got is interest. Now, this interest is loan, how interest percentage, you have to compute this interest percentage. So, interest percentage, you have to arrive at the value of interest percentage, that is what they have asked, what is the repo rate, right. So, interest value is loan, whatever is the loan, how much initial, 200,650 into some rate into 9 by 360. Why 9 by 360? It is given for 9 days, okay. So, you get a repo rate of 5.001 or 5%. But now you see what has happened in this whole repo concept, no, there is one point that you have to understand. You have sold a security and you are buying it back. You have sold a security and this is the loan part, but there is also a security linked to this. So, you have sold a security and you have bought back. So, what is happening is loan is security given minus margin. See the exact loan. So, I am going to give you a loan of, let us say, some 11 crores. Okay, and by buying from you some security at 10.5 crores or by buying some security from you at 11 crores. Then I am going to sell it back to you at 12 crores. Where I give back your security and you give me 12 crores. So, this 11 and 12 represent both the security value as well as the value of the loan. Now, what happens in this is, this 1 crore differential between those two is interest, but also there is this entire security. You have, and I have said here that the same 11 crores of loan is equal to 11 crores of security. That may or may not be possible. Even for argument's sake, it is possible. The security value may change. So, what you will say is, instead of, if you want a 11 crore loan, give me a security of 11.5 crores. And when you repay me the loan, I will give you security value which reflects that. Okay. So, basically how it works is, if you look at this example, you will understand it better. Loan is security given minus margin. So, there is a margin. Margin is 1.25%. So, the loan given is 200,6750. This is the loan that is given. This loan is, if security is 100, then loan is 98.75 because 1.25% is a margin. So, if 200,6750 is the loan given, then it represents 98.75% of the value of the security. So, the security sold value is 2,026,000. How did you arrive at? You divide 200,6750 by 98.75%. Now, face value of the security, see here, 6% government bonds 2022 for an amount of 2 crores. So, the face value of the security is 2 crores, whereas the market value is 2,026,000. How did I get market value? Because that is the security that you have given as deposit or rather a collateral for this loan. So, the dirty price using face value of the bond of 100. How do you find the dirty price? Face value of 100 is worth, this 2 and how many zeros? 7 zeros, which is 2 crores. Then how much of dirty price is your value of the security that is given? See, because face value of the security is 2 crores, but the security today may have some accrued interest, and that accrued interest, including that accrued interest, is 202640. So, 202640 by 2 lakhs into 100, you get basically the 101.3 is the dirty price. With 101.3 is the dirty price, then what is the clean price? Your dirty price minus accrued interest. What is accrued interest? Accrued interest is on this 101.3, you will have 240 days of accrued interest. On this 101.3, you have 240 days of accrued interest. They themselves have given. So, 101.3 on this 101.3, which is basically the dirty price, on this 101.3 is the dirty price, and on 100 rupees which face value, you have 240 days of accrued interest. How? They themselves have given 240 days of accrued interest. So, 100 into 6% into 240 by 360, you basically get accrued interest of 4 rupees. So, 4 rupees is the accrued interest. and 101.3 is basically the dirty price. So, clean price is 97.3. So, the price of the bond which is put as collateral is 97.3. So, when you want 11 crore loan, you give 11, instead of giving 11 crore bond, you give 11.5 crore bond. This 11.5 crore bond will have certain interest, it will have some face value, it will have some clean price, it will have some dirty price. When the loan is repaid, they repay back 12 crores. And this 12 crores is against this particular security what you have given. So, you return back this particular security whatever is there. The loan is repaid back with interest and the security is given back as it is, because you are not the owner of the security, you have transferred back the security. So, this is one kind of interesting kind of problem that may actually be asked in exam. So, please go through this problem once more at peace, you will understand it better. Now, let us look at the last question in this chapter which I want you guys to go through. So, let us look at this question. On 31st March 2013, the following information is available. There is a 0 coupon bond, T-bill, 10.7% GOI bond, 10% GOI bond maturing in 18 and 23. Face values are given, maturity dates are given, coupon rates are given, coupon dates are also given. Now, in this, what have they asked? If 10 years yield is 7.5%, what price does the 0 coupon bond fetch on 31st of March? So, on 31st March 2023 is the maturity date. Current date is 31st March 13, face value is 10,000, 10 years yield is 7.5. So, 7.5% is the yield for 10 years. So, what is the price of the bond today, which is on 31st March 2013? So, how many years do you have? Enter 13 to 14, 15, 16, 17, 18, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23. You have exactly 10 years. So, in these 10 years, the maturity value will be 10,000. What is the price today? If the yield is 7.5%, it is simple. 1 by or 10,000 divided by 1.075, 10 times is equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 4851.9. Simple. That's all. There is nothing else in this question. Next question. What will be the annualized yield if T-bill is traded at 98,500? So, this T-bill is 1 lakh. Maturity date is 20th June. So, 20th June means how much? And this is 2013. 2013 is not anyway, leap year is irrelevant. They run 31st March. So, April 30, May 31, 61 days, and you have 20th of June is 20 days. So, 81 days. So, for 81 days, currently the T-bill is at 98,500. So, what you do? Face value, which is 1 lakh minus 98,500 by 98,500 into 365 by 81. You will get 6.88. Please note, all instruments are multiplied by 365 other than repo, reverse repo, which is 360. Next, 6.86, very simple. Then the 10.75% GOI bond having YTM of 8, what price would it fetch on April 1 after coupon payment on 31st of March? So, once the 31st March coupon payment is made, it is single coupon every 31st March, it is maturing in 10 years, its current, its face value is 100, its current yield is 8%, coupon is 10.71. So, so you have to first compute the present value annuity factor at 8% again it is single coupon. So, you need to compute for year only. 10 points, you have to compute at 8%. What is the present value annuity factor for 10 years? Sum. Multiply that with 10.71 and maturity value of 100, 10th year present value factor at 8%, you arrive at multiply. Sum both of them, you get a value. That is what it is. 10.75% at 8% for 10 years plus 100 at 8% for only 10th year. So, you get 71 plus 46, you will get 118. So, 118 is the price. Now, you see if the yield goes down, yield compared to the coupon is 10.71. Yield is below the coupon, the price of the bond will go up above your face value, which is 100. Last one, you have a 2018 maturing bond, face value is 100, coupon rate is 10, interest is paid twice a year. If 2018 bond having maturity is having YTM is 8%, what price would it fetch on 1st April after the coupon payment on 31st March? This is also same logic, but here Instead of, the yield is 8%, so you divide it by, you compute everything for 4% because it is semi-annual coupon. Coupon is also 10%, but since it is semi-annual, you take coupon values as 5 and you do exactly like the previous one. So 5, which is a coupon, into at 4% for 10 periods. Why 10 periods? Because you are in 2000, the bond is maturing in 2018, you are in 2013. So 13 to 14, 15, 16, 17, 18. You have 5 years, 5 years into 2, by two interest payment dates. So 10 periods. So for each of the period, 4% for 5 rupees. And balance 100 rupees, whatever is the maturity value at 4% after 10 periods, you arrive at a value, you get 108.11. So this is another, kind of variety of problems that you can get. But please note, the repo, there is always a security attached, and the security that is attached will have a face value, will have a clean price, will have a dirty price. In addition, there is a loan that is given, the loan is given, and then money is again received back. Right. So that is one particular kind of problem which is slightly convoluted in this. And also remember that repo is for 360. All other instruments, when you compute their yield, you compute it based on 365 only. And all the instruments you actually have are issued at a discount. Okay. So these are the kind of problems that you may get in the exam. And this concludes this particular revision of this chapter, Security Valuation Bonds part as well. We have already completed Security Valuation for equities. Now we have completed Security Valuation for fixed income instruments, bonds, debentures, T-bills, repo, reverse repo, bunch of things, whatever we have discussed so far. Okay. Now, please note all these questions and the solution. The compiler itself is available on my website free of cost, on our website free of cost. You can download it by clicking on the description, by clicking on the link available in the description below. Okay, so I hope that this entire revision session has been useful. There are more revision sessions. I hope all of them turn out to be equally useful for you. All the very best.